Hello everyone, Radhe Radhe. In today's lecture, I am going to make you revise all the notions of derivatives analysis and valuation chapter in a very detailed manner. We covered this chapter previously in regular batch in total of 5 parts in which we read around 17 topics. So in regular batch, when I covered this chapter in which I have covered various concepts, questions and everything in that. Before starting this chapter, I gave some specific guidance to you all related to this chapter, which was the most important. I would like to say the same thing which I told there in this video because there will be some students who have come here directly to revise who have not studied from me in the regular batch. So there are some specific things for those people. Keep them in mind, then proceed further in video. Firstly, when you hear the name of this chapter, only one thing comes to your mind, that there is no other chapter more tough, more lengthy, more useless than this in whole syllabus. You have a fear in your mind that there is no chapter more tough than this, and what is the reason for that? Either you have read from here and there who have given useless knowledge, or if you are reading this chapter directly for the first time, then your seniors must have scared you. They must have told you that there is a chapter in your syllabus named derivative and there is nothing more tough than derivative. Firstly, I will remove this myth of yours because this is a lie that this chapter is the toughest chapter, and believe me, there is no easier chapter than this one in your whole syllabus. This is a very small and easy chapter. As I made you study in batch, all the questions became easy for you. Similarly, when I will revise, you will realize there is no chapter easier than this. But it has a condition that you have to understand the feeling of this chapter. What are the derivatives? You will have to know its feeling. You have to know its crux. Just keep it in your heart, which I told you in the regular batch again and again. That keep it in your heart. So you will never have any problem in this chapter. It is very easy chapter. Once you understand crux of this chapter, if you understand the meaning which I cover in first part. In this chapter, when I explained the first part to you, then in the first part we were just understanding the feeling of the derivative. It is not that there will be question from first part in exam. Not a single question comes from that, but it will only help you to understand so that you never face any problem in understanding rest of the chapters in your whole life. After this, when I talk to you about the exam questions of this chapter, so they are more easy than this. I mean, while understanding the concept of this chapter, you may feel that something different is going on. But when you attempt the question of it, then you will see that there are very easy and small questions in it. Repeated and very small questions comes in exam, there are very easy questions. If you get the question of this chapter in the exam, and you have read my concepts properly, then it will be like free marks. And if you understand this chapter, you understand the feeling, you understand the crux which I have already explained to you, and again make you revise today. If you understand that, then you don't even need to read the notes. You can directly do the questions. It is such an easy and simple chapter. So this thing I am telling you the first, after that we will start this chapter. So for this, I have told 3 requisites, pre-requirements to understand this chapter. Keep it in your mind. The first thing of them is, if you have studied from somewhere else, remove all prior learnings from your mind. Whatever you have studied earlier, think that it was garbage. Whatever I am teaching today, remember it. The second thing, there should not be any if and but while listening the lecture. That means you have to listen only what I have said. Don't use your extra brain. If such a scenario would have been there, so what would have been done? So you will be left revolving in it only and your chapter will be left. So again, concentrate here. And the third thing, if someone is doing practical trading in derivatives, then don't use your practical experience here. They will say that, sir, we do this. What knowledge are you giving? You don't have any knowledge. Leave knowledge. Here we are preparing for exam. Knowledge is different matter. Whether I have knowledge or not, that's a different matter. I don't have to tell you that. I am talking about getting you prepared for the exam here. So there is big difference between an exam and practical life. There is a lot of difference which I have explained to you in the whole batch and told you what is the difference. So we will not talk about that, but you have to study according to exam. I am going to teach that, so just listen and follow only what I say, nothing else. This will be just chapter for you. So let's get started. We won't waste much time now. Part first, introduction to derivatives. First of all, understand what derivatives are. What are derivatives? Once you understand this, then nothing will be left in this chapter. Then you will be able to understand this chapter. That's why we are doing this calculation. Just understand it with feeling that this is most important. Some people will be over smart, so they will think that let's skip this part. It will not come in the exam. If you skip this, then your chapter will be skipped, because this is the most important thing in order to understand what is derivative. For that, I have wrote first topic, meaning of derivative. What is its meaning? Write its definition. Derivative is a contract between two parties which derive its value from an underlying asset. This is the definition of only one line. Just because of that, you have to read the whole chapter. All the crux is in only this one line. What is this derivative? Derivative is a contract between two parties. You and I are here in front of each other. We both are sitting and doing a contract on a piece of paper. This contract can be a derivative contract. Sir, if we do any contract in the world, as there are many contracts, we have been reading through the foundations that there are many types of contracts. Is every contract a derivative contract? As defined, derivative is a contract between two parties. So is every contract a derivative? No. Only that contract will be called a derivative contract, whose value is derived from an underlying asset. Understood? A contract which has been finalized by both of us, meaning you and I together make a contract whose value is being derived from an underlying asset. This contract is called a derivative contract. Sir, what is an underlying asset? For now, just understand that an underlying asset is a reference of an asset given in a contract. In that contract, the name of an asset is given. That underlying asset can be anything. It can be any asset. Machine, land, building, furniture, calculator, pencil, it can be given for anything. Underlying asset can be anything. That means the value of my contract is based on that underlying asset which is mentioned in that contract. The underlying asset which has been mentioned in the contract, as the price of that underlying asset fluctuates in the market, the value of my contract will also change accordingly. The contract is deriving its value from the price of underlying asset. So the changes in the prices of underlying asset will change the value of this contract. This is a contract. We have done this contract on a paper. Suppose this is a piece of paper. We have done the contract on this paper. There is no value of it. You can get it for 1 rupee in the market. But from where does this contract derives its value? An underlying asset. The value of this contract depends on underlying asset. In layman terms, we can say that the value of this contract is dependent on an underlying asset. It relies on this particular asset. So this is a derivative contract. After this, I have written about underlying asset. We will understand this later. First, see this in detail. We have to understand a lot of things in this. Let's first get clarity about it, as it is a bit difficult, but I will make it easy for you. Now I have told you so much that you may not be able to understand what is underlying asset, what is value deriving. I'll try to help understand in an easy language. Pay attention. That's why I wrote the point that derivative contract is entered into. Means this is a contract, and in this contract, this is a piece of paper. You and I, we both are signing the contract. Now what kind of word should I write in this contract? What kind of wording should be written in this contract so that the value of this contract is derived from an underlying asset? What should be written so that the value of this contract is derived from an underlying asset? Meaning this contract becomes a derivative contract. Which means when you and I are signing a contract together, what should be the wordings? What should be written in the contract so that the contract becomes a derivative contract? The most important thing to understand is that the contract which is being signed, it should be there for performing a transaction on a future date. The contract which you and I have signed is to execute a transaction on a future date. Are you following? So that contract has been signed to perform something in future, meaning a future transaction. To perform a transaction in future, derivative contract is done. It means contract to buy or sell underlying asset on a specified future date at a prefixed price. Sir, couldn't understand what you said. Let's understand through an example. Now I am going to give you an example by which you will get complete clarity. See, this is my piece of paper here. This is a piece of paper, and what should be written in it so that we can call this contract as derivative contract. This means that in this contract it should be written that we will do a transaction on a future date. Meaning a future transaction will happen which will make this contract a derivative contract. Now I will make you understand with an easy example. Suppose as a person, I saw a property, and when I saw it, I thought that as per the market standards, this property is very profitable and its value can get doubled in the next 6 months. Suppose today this property is available for rupees 1 crore and I get a feeling that its value will reach up to 2 crore within the next 6 months. So I should buy it. Okay. So I approached the other party and said that I like this property of yours. You write the property in my name and you want 1 crore, so take it. So we made a contract where it is written that today I am buying a property from the owner and I am paying him 1 crore. Now tell me if the contract is derivative. This is a normal contract. No value is being derived from underlying asset in this contract. This is a normal contract. I have given him money and he has given me a property today. We wrote this on a piece of paper. So this is a normal contract and there is no derivative component in it. Now I will give you an example of derivative. When will this contract become derivative? Suppose I like that property a lot. Why? Because I feel that after 6 months the value of this property can be rupees 2 crores and today it is available for only 1 crore. So I become greedy that if I buy it in 1 crore, then after 6 months its price will become 2 crores and I will earn profit after selling it in the market. So I went to the concerned party and told him that, brother, I really like your property and therefore I would like to buy it from you. He said, okay, take the property and give me 1 crore today. I said that I don't have 1 crore today. He angrily asked me to get out of there if I don't have that much money today. I said, brother, listen, I don't have money today, but after 6 months I can give you money. I will surely pay you after 6 months. I told him that I don't have money today, but I want to buy this property because I have become greedy as the price of this property will increase. So he said that if you will have money after 6 months, then come that day and take the property according to the price of that day. Now tell me, what will I do after buying the property that day? Because I know that after 6 months its price will become rupees 2 crores in the market. So what will I do after buying that property for 2 crores? I wanted to buy it today so that I can buy it for 1 crore and sell it for rupees 2 crore to earn profit. So I told him to listen to me. It's obvious that I want to buy your property, but I will be able to give you the money after 6 months. So do one thing, sign a contract with me. I told the other person to sign a contract with me, and in that contract it will be written that you will sell this property to me after 6 months. And I will give you 1 crore 20 lakhs in return. How much? 1 crore 20 lakhs. Now tell me, will the other person accept this offer or agree to the contract? He will, because what I told him was that today you are asking for 1 crore for the property, and it is a simple thing that if I pay you after 6 months, then I should not pay 1 crore. Why did I say 1 crore 20 lakhs? Because it is obvious that if I had given you money today, you would have invested somewhere, earned interest on it. So after adding them all, I am giving you 1 crore and 20 lakhs. I will give you 1 crore 20 lakhs after 6 months. You just sign the contract today that stating that after 6 months you will sell me this property. And I will pay you rupees 1 crore and 20 lakhs. Just sign this contract today. So now finally the other person agreed to sign the contract with me. He signed that contract. Now tell me which contract is this? This is a derivative contract, right? This is a derivative contract, okay? Today the contract has been signed on paper only. There is no transaction. There will be a transaction on the future date. For doing transaction on a future date, follow the definition, contract to buy or sell underlying asset. What is the underlying asset? In our case, it is the property, land and building. That is our underlying asset under this contract. The asset mentioned in this contract is called the underlying asset. Contract to buy or sell underlying asset. I am signing a contract to buy. My contract is to buy the underlying asset. For him, it is a contract to sell on a specified future date. What is that date? After 6 months. An exact date will be mentioned in the contract, but for us, what is the specified future date? After 6 months at a prefixed price. Even the price got fixed today, which is 1 crore and 20 lakhs. We fixed this to today. So now see, the whole definition has been met. So this is what we call as the derivative contract. Okay? Sir, why did the other person agree to sign this contract? I understand that I have greed and I think the price will reach up to rupees 2 crore. So what's wrong if I buy it for rupees 1 crore and 20 lakhs? Why did the other person agree to sign the contract? He was scared. He thought, what if the price of this property falls in the next 6 months? He was afraid that the government might change and the price of the property might become 90 lakhs or just 80-90 lakhs. So as soon as I told him that I will buy it for 1 crore 20 lakhs after 6 months, he happily signed the contract. So I will tell you why people enter in derivative contract. Understand this sincerely, people enter in derivative contract for 2 reasons. Why someone signs derivative contract? Either he is afraid of something or he has greed. A person enters into a derivative contract due to fear or greed. There is no other reason. It's a simple fact. That's why he agreed to sign the contract. I made you verify it completely. This is called a derivative contract. Understood? Now sir, you told us that it is for doing transaction on a future date. We verified that too. That the contract is being signed to do a transaction on a future date. You told us about derivative contract. But according to above definition, how is this a derivative contract? There are 2 parties involved in this contract. Now how is this contract deriving its value from the underlying asset as the contract, which derives its value from the underlying asset? That should be called as derivative contract. So for that, let's continue this example. Try to understand it. Let's see what happened. When did I sign the contract? Look, I signed a contract. Suppose we have signed the contract on 1st of January. What contract did I sign? That after 6 months I will buy this land from you in 1.2 crore, meaning 1 crore 20 lakhs rupees, okay? After 6 months means 30 June. So today the contract has been made. There is no transaction of money today. Payment of money, or when will the transaction will happen? 30 June, which is after 6 months, okay? Now what happened? I signed contract on 1st of January, and upon signing that I was so happy that I slept thinking that I have done a good job. Now the price of this property will increase and I will earn profit after buying it for 1.2 crore. So came 31st of January. 31st January. It's been a month, and so today is the 31st of January. What is today? 31st of January. And on this day I saw that the property for which I had contracted that I will buy it on 30 June at rupees 1 crore 20 lakhs, the market value of that property has become 1.5 crore. How much is it now? Rupees 1.5 crore market value. I have made a contract that I will buy it for rupees 1.2 crore. Now I am thinking that 1.5 crore is the market value today. So at least this price will continue till June 30. According to me, 1.5 crore will continue till June 30. Neither it will increase nor fall. This will be the market value. Now think what will happen if the market value on 30th June is 1.5 crore. I will buy the property from the other person and will pay 1.2 crore. He will have to sell it despite the market value, as contract is already done. And I will buy it for rupees 1.20 lakhs and sell the property for rupees 1 crore and 50 lakhs. It means profit of 30 lakhs. Property worth 1.5 crore is available for 1.2 crore. I have never been this happy in my whole life. I have never been so happy in my whole life. In the Partner movie, the dialogue which Govinda said after watching Katrina, that same dialogue was being said by this guy. Okay, so today he is throwing a party to the whole world. Why is he throwing this party? How did he get this happiness? Why did I get this happiness? Because I had signed this contract. If I had not signed this contract with the other person on 1st of January, then I would not have been happy. Or if I had lost the contract, then I wouldn't have been happy. The other person would have asked me to show the paper on 30 June. Got it. So I am getting this happiness because of this piece of paper. It means the happiness of this piece of paper is rupees 30 lakhs. This piece of paper is worth rupees 30 lakhs. If I lose this piece of paper, then I won't get the profit of rupees 30 lakhs. Did you understand? I can buy a property worth rupees 1.5 crores in 1.2 crores because of this piece of paper. And if it is lost, then there is nothing. It is the value of a piece of paper. See, this is a derivative contract. What is underlying asset? This property. As soon as the price of this property changed in the market, 1.5 crore, the value of this paper will change. If you think of the other person, that what's happening to him, then today is the worst day for that other person. He is in depression. He is not even eating food at home. Why? Because the market value of the property is 1.5 crore, and what had he done? He signed a contract to sell it for 1.2 crores. Now he is thinking that I will have to sell the property of 1.5 crores in 1.2 crores. I have lost an opportunity of 30 lakhs for no reason by dealing in this contract. Did you understand? So for him also the value of paper is the same, but in terms of loss. Now suppose another month has come, that is 28th of February. On 28th February, the market value of this property was rupees 1.4 crores. So tell me what happened on this day. On this day, I will see that market value is rupees 1.4 crores. Now I am not that happy, but still happy because I have contracted to buy it in rupees 1.2 crores, and so there is a profit of 20 lakhs. It means the value of this piece of paper is now 20 lakhs. So as the price of the underlying asset is moving in market, the value of this piece of paper is changing. So the value of this paper is dependent on the underlying asset, hence it is a derivative contract. I have explained everything in detail. So this is the case of derivative contract for doing transaction on a future date. This is called settlement by delivery. On the day of maturity, we will do the delivery and settle. I will buy the property and give him money whatever was due. This is called settlement by delivery. Okay? So I explained you what is derivative contract. We'll talk about this in more detail, but since you understood this much, so there will be no problem. Now I had written here what could be the underlying asset. So look, underlying asset, now according to your syllabus, there are 4 underlying assets you have to focus upon. I have given the example of property, but you can do derivative contract on anything in this world. According to this syllabus, there are 4 things. First is equity. Equity means share or index. You understand the index, market, Nifty, Sensex. I have told you in portfolio. Revise it. If you don't revise it, then it doesn't matter. Derivative contract over share. Yes, let's say there is a share of Reliance and I have taken the contract of derivative that after 3 months I will buy Reliance's share at 500 It can be over anything. This too as a commodity. Commodity means wheat, rice, millet, gold, copper, for anything. Suppose I have contracted that after 3 months I will sell you 100 kg of rice at this rate. This can also be a contract. For example, to buy or sell currency like dollar or pound. So we see the derivative of currency in the forex chapter. It can also be over interest rate. Suppose I want a loan after 6 months, but I feel that the interest rate will increase in the market. So I go to the bank and tell him to give me loan after 6 months, but fix the interest rate today itself. This is also derivative contract and underlying asset interest. So derivative contract can be for anything, but we will see currency in forex chapter and interest rate. In IRRM chapter, we will focus on equity derivatives and commodity derivatives. These two have practical portions that we have to see in this chapter, in which major part is of equity derivatives. Such derivative contract which has underlying assets like equity, share or index, this chapter focus on that particularly, specifically. So we will take an example of that and move ahead. Now example of that in case of share. The share of Reliance, I will buy it from you after 3 months at rupees 2500. So contract by underlying asset Reliance share specified by switched end after 3 months. Prefixed price 2500. Same thing, nothing special. Watch after that. I told you this point in this chart. See the other side of this chart. What is written there? I have not explained that yet. Now I will tell you. So why do we enter derivative contract? Because we have to do transaction on future date. If someone is thinking too much, he can also say that if you want to do a transaction on future date, then you can do it on that day. If you want property after 6 months, then go after 6 months. What difference will it make? Why are you doing contract or you studying these chapters? So whatever I taught, you have not understood. I said that person enters because of his fear or greed. What I was thinking that the price of the property will increase. That is why I want to fix a price today. So when the price will increase after 6 months, what will I do actually on that day? Are you understanding it? So here people enter into derivative contracts to cover their fear or greed. If you have any doubt, I have told you. Now you understand what is the second purpose of derivative contract. It is betting. Betting means to bet or to play gambling on the price of underlying asset on a future date. It means gambling. Betting, this is the main purpose of the derivative contract. Ultimately, the purpose of derivative contract is betting. There is the betting inside the derivative contract. So you are betting on the price of underlying asset. So I just told you right about doing transaction on the future date. You were just betting and doing nothing else. I will give you the whole crux. Ultimately, try to understand for betting on price of underlying asset on a future date. That means what will be the price of the underlying asset on a future date. Will underlying asset rise or fall? You can make also bet on this. That is called as derivative contract. Look at the example. Now you will understand. Now I will take the example of Reliance share. First I will make you understand about doing a transaction on future date. What I said is I am Mr. A. What I told Mr. B that I will buy Reliance's share in 2500 after 3 months. So Mr. B will sell it to me. He sold the contract and I bought the contract. After 3 months its price has become 2600. So what will I do? I will purchase it in 2500 as I have already signed the contract. And since the price in the market is 2600, I will earn a profit of 100. And Mr. B, he did contract to sell, so he will have to sell. Sell at 2500, and from how much he bought it from market? What is the market price? 26,000. So he suffered a loss of 100 rupees. In derivative contract, the profit of one person is actually the loss of another person. Derivative is actually 1-to-1. It's simple. If I am sitting on profit, that means I earned a profit on someone's loss. Because today he is crying on his loss, he suffered a loss today, that's why I am in profit. Understand this, profit loss is 1-to-1 game in derivative. So it is for doing transaction on a future date. Now what I have said is that the main purpose of derivative is to do betting, to bet, to gamble. Now you understand this is called betting in English. Now what is the meaning of betting? See Mr. A. Mr. A is saying that Reliance share will rise after 3 months. It will rise above 2500. He is doing upside betting. So what Mr. B is saying that after 3 months the share of Reliance decreased 2500. Downside betting. Sir, why is that? In this Mr. A is thinking that price will increase and Mr. B is thinking that the price will decrease. Sir, his point of view of two people could be different? Yes. Everyone has different point of view, then only derivative contract is possible. It's a normal thing. Like I tell you that some people like Modi, but there are some people who don't like him. These differences happen. In the market, there are all kinds of points of view. So the same thing works here. People enter the contract according to their own point of view, according to their own feelings, and then the outcome comes at the final maturity. Now, in this case, after 3 months, the price of share increased by 2600 in market. Mr. A said that price will be increased, it will go above a 2500 price. And it goes above, as much increased as much profit. 2600 minus 2500, it means profit is rupees 100. What Mr. B said that the price will go down, it will be a profit if it goes down, but the price has gone up, so it has a loss of rupees 2600 minus 25, it means 100 rupees. So in this case, Mr. B will take out a note of rupees 100 and give it to Mr. A. Did you get it? So this is the derivative contract. And we call this case as cash settlement. The case of betting is known as cash settlement. In cash settlement, there is no meaning of Reliance's share. Mr. A and Mr. B don't care about Reliance's share. Even if Reliance's share is completely destroyed, they don't care. Ultimately, they wanted to bet on it. They wanted to make a bet and earn money. So for betting on price of underlying asset on a future date, derivative contract is done, that is contract of upside betting, or the contract of downside betting on price of underlying asset on a specified future date at a prefix price. And here we have our cash settle. There is a cash settlement. Now I was telling you again and again for doing transaction on a future date. Even in this you are doing betting. But you are writing professionally, but in exam or in practical life, in contract it is written that we are playing gambling. We are betting. So will it look good? No. So you are writing professional language. If you read the notes on the betting side, then in the bracket of contract of upside betting, I wrote by contract to buy. In the contract, if I wrote contract to buy, then it will mean that I am contracting to buy the underlying asset on a specified future date at a prefixed price. Then in this case, I am doing a contract of upside betting. Similarly, in the contract, if I wrote sell in bracket, it will mean that an underlying asset will be sold on a specified future date, which is called downside betting. So these are just the professional betting terms. Now, let's verify them and understand. I will come back to this example for doing transaction on a future date. So what I was saying to the other person that I will buy the share of Reliance from you after 3 months at rupees 2500, I will buy it. So tell me, why am I doing this contract? Once think about it. If a person has a normal brain, then why that person will be doing this? Because he must be thinking that the price will go up after 3 months. So if I feel that the price will go down after the 3 months, so tell me, am I a fool to sign a contract to buy at rupees 2500 if you have doubt? That's sir, my expectation is to go down, so why cannot I contract to buy? Then there is no biggest fool like you. Understand, I think that price will go up, then only I will talk about buying in that much. If I think that price will go down, then why will I talk about buying it? So what I think, the price will go up, and this is why Mr. B contract to sell, because he thinks that the price will go down. So what is Mr. A doing? He is trying to do upside betting, and that person is going to do downside betting. One is betting on the upside price and other person on the falling of price. So they had a loss and a profit of rupees 100. In this case also, it was the same example, and they had a loss and profit of 100. I had just put the word betting in it. It means in this scenario, see, what Mr. A was doing, on maturity, if settlement is done on physical delivery, he will buy in 2500 and will sell at 2600 in the market. The profit of 100. What will Mr. B do? He will purchase at 2600 and sell it to Mr. A at 2500. So he will bear the loss of 100. So we talk to each other that we will do a big process. You will buy from market and then you will sell it to me, and then I will sell it in market. So you will have a loss of rupees 100 and I have to gain profit of 100. Do one thing, let's settle it in cash and you give me a note of rupees 100. So here if we put cash settlement in it, it will become a betting contract. So derivative contract is ultimately of betting. This is a professional language. So it will not be written in the exam that contract of upside betting. It will be written that we have done contract to buy underlying asset. Understand it? It's upside betting. Because now all the questions we will do in the exam all are about cash settlement. We are going to do it with the thought of cash settlement. Because in practical life, generally in all the derivative contracts have cash settlement. There is one case of physical settlement that I will tell you where you have to think. Rest will be cash settlement. In our thinking, whenever I will teach you a topic or you will link questions, then think only about cash settlement in it. Think only about the betting point. Okay? Even if this wording is not written in the equation, doesn't matter. Contract to buy means upside betting and contract to sell means downside betting. I explained it with reason. This is derivative. What is derivative exactly? So you all understand it, feel it, and then once you understood, we will move ahead and you will get more clarity in detail. Then We saw that the topic of participants in derivative contract. What kind of people participate in it? It is useless, will not come in exam. Understand this once. If you get the wording in the question, then you should know who are these people. In the derivative, people like you and I go, just have given them a category wise name. Okay, they name them. They are not special people. First of all, speculator. Speculator means greedy people. Greedy people don't care. Suppose we are talking about shares here, as in this chapter, our focus is on equity derivatives. This guy has nothing to do with Reliance's share. He just wants to earn money by betting on it. He has no fear. He came in greed and entered in derivative contract. He has greed that price of the product will rise or fall. Whatever he thinks, he will put condition and will think to earn money. It's not necessary that what he thought on maturity will happen. Like in our example, Mr. B was thinking that the price will fall, but it didn't. It increased, so he bears loss. Ultimately, a person that bears a loss, and the more loss he bears, the more profit other person will get. Speculators are greedy people. They don't have any existing exposure. So exposure meaning is risk. Risk means they don't have fear. They are not afraid of anything. They don't enter because of fear. Just because of greed, they want to earn money by betting and gambling. They want to earn profit by betting. Second category is hedgers. Hedgers are those people who enter into derivative contract due to fear. Those who are afraid of something. Those who have an existing exposure. Exposure means risk. Risk means fear. They have an existing fear. And because of that fear, they enter into derivative contract. Why they want to be hedgers? In order to end their risk and the fear, and in order to take a peaceful sleep. They could get a peaceful sleep. That's why they enter in derivative contract. These are hedgers. They will also do betting. I said in derivative contract, there is cash settlement in practical life. There is only betting. They will do betting, but to end their fear. For example, I have a Reliance share of 2500. I bought it and I wonder that after 3 months its price will decrease in the market. So what to do? You gave me this suggestion to sell it. I said, brother, I cannot sell it today. Then you will say that why are you talking rubbish then? That you are afraid that the price will decrease. We are giving the suggestion now to sell it. You are denying. So listen to me properly. I could not sell it today because I have reason. Reason can be anything. I take its example. The reason is that if I sell this share, then I will have to pay income tax at a high rate. As per Income Tax Act, there are some rules. But if I will sell this share after 3 months, then my income tax will be exempted. Income tax has rules like capital gain or something like this. But assume it once, don't link it in the actual. I am giving you a reason. Hedger has a reason to be afraid. Okay? So it means I can't sell it today. I can only sell it after 3 months. If I sell it after 3 months, then I feel that price should not fall in market. What to do? Do derivative contract. Do contract to sell today. Fix the price and come. It will be sold at that price. If you do contract to sell, then you will do betting contract, meaning downside betting. You will put a bet on whatever you are scared of. Do you know what a hedger does? He puts a bet on things he is afraid of. If you are scared that price will fall, then bet on it and you will gain if the price falls. If the price falls here, then no worries, you will gain from here, and when actual price will fall in market, it will be sold. And the gain will come from here. So finally you will get the same price as the initial contract. Rest you will understand when detailed topic will come. Next you can see here is arbitrators. Arbitrators are people who don't have any existing exposure or risk. They don't have any fear. They are greedy people. They are greedy with mind. Why are they greedy with mind? Because they earn riskless profit in the market. Riskless means a profit that they will get guaranteed every time. There is no risk in it at all. How do these people do it? They take advantage of mispricing in the market. For example, I am an arbitrager. I saw that a person is ready to make a contract with me. He will sell me Reliance share after 3 months at rupees 2500. Similarly, there is a person in the market who is ready to buy Reliance share after 3 months at 2700. I have made the contract with both of them. From one person I will buy the share of Reliance for 2500. On the other hand, I will sell the share with second person at rupees 2700. After 3 months, I bought it at 2500 and sold at 2700. Hence earned a profit of 200. Okay? This is arbitrager. Arbitrage is the best thing to do. Tell me, is it possible in practical life? In practical life, it is not possible in the case of shares, because first of all, you will not get the pricing, and even if you get it, you will get it for very less money. If you get those couple of bucks, even that is valid for a few seconds or milliseconds only. How is it done? There is an algo trading in the market. It is done by using a fully computerized system. Only those people do arbitraging. No one can do it directly or manually. So don't say that we should do this in practical life, not possible. Let's see after that our next topic, classification of derivatives on the basis of underlying asset. How to do classification of derivatives on the basis of underlying asset? I have already explained, just write it. See, derivative contract is, I told you that there can be different types of underlying assets. If we put equity underlining in it like share or index, then it is equity derivative. I gave you an example of how the contract will be. Now what is index? It is Nifty Sensex. There can't be a contract to buy sell means settlement by delivery. If I say that after 3 months I will buy Nifty from you for 25,000. So, sir, Nifty can't be bought and sold as it is index value and points. From where does the rupee come from? So to make a derivative contract, the points or index value of Nifty or Sensex is considered as rupees. Suppose if there is 1 point, then it is considered equal to 1 rupee. If it is 25,000 points, then it is considered as 25,000 rupee. This works practically and also for exam. Fit it in mind? So in Nifty Sensex, IT is not done from betting purpose. Derivative contract is done for betting purpose. You can bet on the index that after 3 months Nifty will go above rupees 25,000. One person is saying that no, it will go down. If it goes up, then it is gain, and if it goes down, then it is loss for me. So this is how equity derivatives are made. The second one is interest rate derivative. The derivative contracts in which underlying asset are interest rate, this we will study in IR. Then currency derivative. What is currency derivative? Underlying asset currency. Commodity derivative, underlying asset commodity, you have to see it in this chapter. It is practical portion, main is equity derivative. There are some other derivatives like credit derivative, weather derivative, electricity derivative. Now what are these? See, the theory portion is in syllabus. You don't have to read any practical part in detail. It is just a theory portion which I will cover when I will teach you the theory, so you have to refer it from there. It is of no use, it is a garbage topic. Keep it in your mind. This theory is garbage. Now what is the meaning of it? Credit means what? Loan. I gave loan to someone and now I have to do derivative on it, whether the other person will do default or not, or whether derivative. What will be the temperature in this city after a month? How much will be the rainfall? How much will be the humidity? Betting on all these. Or betting on electricity prices. What will be the price of electricity per unit? Or contracting on it, you can do anything. So these will be what? The derivatives. The logic will be the same, but your theory portion will be covered in theory. Are you guys getting it? Now see, types of derivative contract. In this chapter, I have told you what to study, equity and commodity derivatives. The main focus should be on equity derivative. Now the types of derivative contracts. First you have done classification and then types. This is what is there in this chapter. This chapter is very wide and people mix it up in such a way that there is no limit. That's why it is tough chapter. I have summarized it and gave it to you. What is the meaning of types? See, there is a derivative contract. I told you about the underlying asset, suppose equity shares, so it become equity derivative. Now in this derivative contract, some extra conditions are written for each line. The condition of each line will decide the nature of the contract, whether it is a forward contract, future contract, is of option nature or swap nature. Derivative contracts can be of 4 types. So, derivative contract can be of 4 types. It depends on what is the extra condition that is written in the contract. We will see it line by line. I am not telling you now because everything will mix up by telling now. And I will make you revise line wise. Have you got the point? This is what we have to learn. Every type of derivative are 4 in number, so we study it accordingly. Let's start second part of this chapter, forwards and future equity derivatives. I have said that this chapter focuses on equity derivatives. That is the derivative contracts in which the underlying asset is equity, means share or index. We have to study that. So we are going to study forward and future contracts. Forward and future type derivative contracts of equity. Only equity should be there in mind in underlying asset. Don't think about any other topic here. Study respective topic in respective chapter. Focus on what you are reading here. Only share or index on underlying asset should be in your mind. We are studying according to that only, so forwards and futures. We will cover both in this part second. This topic is the most important part from exam point of view, as majorly you will get questions from this topic. So please concentrate here. It is very easy. Understand. What are forwards and future contracts? Understand that, then I will explain its meaning. So we were talking about forwards and future equity derivatives. The derivative contract where the underlying asset is equity. Is it clear? Second thing, sir, you have made forward and future as one part. So why are you teaching them as one? You should have taught forward and future separately. You are telling the same meaning of both. So I can tell you that forward and future contracts are almost the same. The only difference between both of these is that the forward contract is done over the counter and the future contract is done through a stock exchange. As simple as that. Got it or not? Okay. Forward contract is done over the counter. If you are doing forward contract, then it is over the counter. It means you are sitting here and I am sitting next and we both have done contract. We have done the contract on table. If two people have done the contract sitting in front of the table, then you will call it forward derivative contract. If two people are in front of each other on table and doing derivative contract, then it is forward contract. OTC, okay. Do not understand that OTC means pizza and you are adding onion, tomato in it. Don't think there is forward contract done for pizza in OTC. It is not like that. OTC means over the counter, sit face to face. What is future contract? It is done through stock exchange. Future contract done through stock exchange and there comes intermediary in between. Stock exchange you understand is like NSE and BSE. Suppose there is NSE. NSE has ground floor. If you go to the ground floor of NSE, then you can buy and sell shares of any company in cash. Okay? You give money, then you can buy shares. You sell shares, then you can take money. This is called as cash market or cash segment. As soon as you reach the first floor of the stock exchange, there is running a derivative market or segment on it. Here you have to do betting on any company share or index. You can do future contract. Future contract is done through stock exchange. You don't do it face to face, only through stock exchange. Someone will say that, sir, you don't know anything. It doesn't happen like this. I am making this image just to make you understand. Otherwise, I have been explaining you from the security valuation chapter that there is no trading in the stock exchange. Brokers have many platforms and apps like Edelweiss, Finance, Motilal Oswal, Zerodha, Angel Broking, etc. in the market. So you have to make an account on them and you can directly trade there. You can buy and sell shares of any company. Similarly, through the same platform, there is a derivative segment on the same platform. You get a segment of future through which you people can enter the future contract. Also through the same platform where earlier you guys did the trading. It means you can do betting on any company's share or index. Got my point? So practically you have to do it through digital platforms, but make an image in your mind that there is a cash market running on the ground floor of stock exchange, buy or sell in cash, and there is a derivative market running on the first floor. You can make a future contract on any share. Okay, in any index, you can do the future contract or you can do the betting. Have you got it? So the derivatives through the stock exchange is called future contract. Have you got the point? Future contract is done through stock exchange and forward is done through face to face. Otherwise, both are same. See, how does the future contract happen through the stock exchange? Now understand the stock exchange plays the role of intermediary. You should not think that I told the stock exchange that the share of Reliance will increase from 2500 after months. It means upside betting. I said that. Sir, you are betting with stock exchange? No. Stock exchange does not bet with anyone. It play role of intermediary. There will be party that will be involved in between. For this, there will be Mr. B who will tell to do downside betting on Reliance's share and say the price will fall after 3 months. He will match both the parties and do the betting and then transfer the profit and loss. But he will never tell both the parties that which party is in front of them. He will never tell Mr. A that who is doing downside betting with him, or he will never tell Mr. B that who is doing upside betting. So what will he say to both of them? See brothers, whatever betting you want, you can bet. If you win betting, then you will get profit, and if you lose, then I will collect the loss from you. Do not take tension of that because I am intermediary. You do not need to know more than this. Stock exchange only works as an intermediary, nothing more. Got it? So it is called future contract. Sir, what is benefit of stock exchange in this? It takes commission initially when parties go to it for contract. It's another matter. We don't have to go in it. It is doing business, not any social service. He also takes commission. So he eats through commission only. He does eat by betting, not by anything else. Do you understand? So basically this was your point in forward and future. Now sir, whom will we call forward and future contract? Okay, got it that forward and future contracts are same. One is through OTC and other is done through stock exchange. So in this entire chapter, we have to consider forward and future as same. Got it? In which there are questions of futures contract. When I say futures word, it means forward is parallel in this chapter. Okay, but now sir, what is a contract? Means how it is future contract. Means what should be the extra condition in the derivative contract. That it will become of forward future nature. So sir, this contract creates an obligation at the part of both the parties which are there. The parties in the contract create obligations on the part of both the parties. That means we can't deny the contract that we have done or agreed. If there is such a contract, then it is the nature of forward or future contract. For example, I made a contract that after 3 months I will buy Reliance share from you at 2500. That person said I will sell it to you at 2500. After 3 months, the market price is 2600. I said him to give me in 2500 because it reached at 2600, so I am about to gain the profit of 100. But he denied that. I am sorry, I will not give it to you. He can't do it. Case will be filed against him because this is a contract obligation. Each party in the contract has to fulfill their promise. In any case, they have no choice. All the parties in the contract have to fulfill their promise. They have no choice. No matter how much they are losing, they have to fulfill their promise, and that is our forward future contract. It means both the parties in the contract have to take an obligation on their part. Guys, got it or not? When they entered contract, they will get an obligation over both of them. On the day of maturity, they have to mature contract. They will have to fulfill promise. They have made promise, then they have to fulfill. Breaking promise will result in case. Understand it. This is forward and future contract. Keep it in mind. Now move ahead. Nothing else. The rest is the same. What is derivative contract? Is for doing transaction or betting on a future date. This is your derivative contract. Hope all is clear. Now let's move to the practical portion of the forward and future exam. First of all, pricing of forwards and futures. What is the pricing of forwards and futures? Pricing means their price. The first point that I have written in this is theoretical value or fair value of forwards and futures. Now, whenever I will say futures, you can interpret it as forwards and futures. It is common in the whole chapter. So I will use futures word. Now this future we are talking about. What should be the fair value of futures? If I am getting into contract to buy Reliance shares at 2500 rupees in 3 months. But where did this price come from? Where did this 2500 come from? If someone says that price of Reliance shares will be higher or lower than 2500. Where did this 2500 come from? Where and how was this price of 2500 of the futures was decided? Who decided this price? How was it decided? This price is mutually decided by the parties involved. On the price they mutually agree. They can decide price they wish. In futures there is a trade on the stock exchange, and through that exchange there we see an actual price. I will discuss that in a while. Now let's talk about what should be the fair price and what is this fair price. Now the parties are mutually deciding that the shares after 3 months will be bought at rupees 2500. The contract is being made between them. Now this price of 2500 is mutually decided, but what should be the fair price? Does this decided price reflect fair price? This fair price theoretically. What should be the fair price speaking theoretically? There is a model called the cost of carry model. A cost of carry model is given by a theorist, and based on that model we can find out the fair price. It is very easy, nothing complicated. What should be the price? The price on which both the parties do not have any problem or do not have any loss. We call it fair value. What should be its fair price at which contract is made between parties? Theoretically or as a fair value, what should that rate be? It's a simple thing. I will tell you with an example. Very simple. Cost of carry model. Now what is the cost of carry model? The underlying share that you are contracting. Simply add interest to today's price. It's that simple. Add interest till the future maturity date. Just add interest. Interest till the date of future maturity of the contract. The reason is simple. Suppose today Reliance share is available at rupees 2400 in the market on today's date. Now listen carefully. If I would have bought this share today from the other party at rupees 2400. Now if that party would have now invested that rupees 2400 in a risk-free investment like a bank, he would have earned an interest. In a risk-free investment security, he would have earned an interest. After 3 months, he would have received 2400 plus whatever the interest. Is that part clear to you? If on 0 time I would have purchased share and given him the money. If I would have given him this money by the time of maturity, he would have got interest on the money. Total value would have been price of share on initial day plus interest. Understood? So if I am talking about buying a share from him after 3 months, then what should be the price? The price of share on today's date plus interest on it for 3 months. Okay, 3 months. Imagine if I am buying land for 1 crore today, but I said that I will give 1 crore 20 lakhs after 6 months after adding the interest to it. That was the calculation. So this is fair price. Assume that there is a risk-free interest rate of 10%. This model assumes risk-free interest rate. because there is some assumptions behind the theories and models. Okay. Without assumption, there is no model, which I have explained earlier. I have discussed it in detail in previous chapters. We are discussing risk-free interest rates here. If market price is 2400 today and he earns 10% interest for 3 months, he will get 60 rupees of interest. After 3 months, he will have 2400 plus 60, meaning 2460 rupees. This is fair price of forward or future. Meaning if I want to get into contract of buying Reliance share after 3 months, it should be at fair value of 2460 rupees. This is what fair value says. Rest will depend on the price in the market or what's possible. It's a simple thing. I should have this price and he won't have any problem. He won't have any problem with this price. This is the cost of carry model. It's very easy and simple to understand. How to add interest? There are 3 ways to add interest in this. Now how to add interest? 3 ways. Simple interest, continuous compounding or monthly compounding. Are you getting this? In realm of practical application, we employ the method of continuous compounding. We can use simple interest, continuous compounding, monthly compounding. You can see all the formulas if you like. This is school level. There is no need to go too deep into logic and derivations of these formulas. What is simple interest? Simple interest is F is equal to S into 1 plus RT. This is all basic school level stuff you've learned. How much will be your total amount on maturity? Principal into 1 plus RT. F means future price. Future price is equal to S. S means current spot price or spot value of the underlying share or index. Current spot price of the underlying share or the current spot value of underlying index. If it is share, then current price, or if index, then current value. Got it? Multiply by 1 plus R into T. R means our interest rate per annum. T means number of days or months of future contract divided by 365 or 12. Depending whether time is given in days or months. Okay. What is the meaning of continuous compounding? In simple terms, it means that interest is being charged on every second. The interest is getting charged on every passing second continuously. So, for continuous compounding, you have to use mathematical tool called epsilon. You don't have to go into too much detail regarding that. It's not part of syllabus. Just keep in mind that epsilon is used. So, what will be its formula? It is S into E with power of RT. Got it or not? Rest with the meaning of S, R and T you are already familiar. Sir, E raised to the power R into T. Now suppose something like this comes in your exam. E raised to the power RT. In our example, there is the spot price is 2400, rate of interest if given 10%. So 0.10, time is 3 by 12. So value of E comes to 0.025. Again, what is our answer? Now how will you get to know this value of 0.025? So this will be always given in examination. You don't have to calculate it by yourself. Keep this in your mind that this will be always given in question of examination. Institute is not teaching you how to calculate value of this. It is not part of your syllabus. It is just basic maths. This value will be always given in the examination of yours. Some teachers will say, come, we will teach you how to calculate its value. You don't have to waste your time on such useless things. You don't have to learn that. It will be provided in the paper during examination. You don't have to waste the time on this. Whatever will be its value, it will be given to you guys. You don't have to use your own mind. Have you understood? Okay. Now monthly compounding interest means every month interest will be compounded, will be calculated every month. In this case, the formula will be F is equal to S into 1 plus R raised to the power of T. Here it was 1 plus R into T. In monthly compounding, T went to power. Here pay attention, you have to take R as interest rate per month. Is this clear? Because monthly compounding is happening, so interest is compounding monthly. Interest rate will be per month. So you have to take interest rate per month in the formula. If you are giving interest rate per annum and it is asked to compound monthly, then divide it by 12 so that you get interest rate per month. Use this way for it. In time, number of months of maturity of future contract will come. What will come in time? Number of months. It will tell us that when future contract will mature, power will be 3 in our example. You have to take care of all this. So these are the formulas of basic mathematics for calculating fair value. There is nothing special in it that you have learned something new. Did nothing new, now look at this. If you want to see some adjustments, then I have written a note in it. First note is if dividend income on underlying share or index is given in question. In fixed amount, divided rate on face value is given, then deduct PV of dividend amount from S, current spot price value of underlying shares index in this formula. And one more thing, if in the question and in the example, it is clearly mentioned that I will buy Reliance share after 3 months at this price. In this case, the underlying share is of Reliance. It says that after 2 months, you will get the income of this dividend. This dividend income will also be there in fixed amount. Suppose rupees 10 or it says dividend rate on face value. It said that 10% dividend will be received on the Reliance share after period of 2 months. Where it said face value of, if nothing is said, what is the face value of the dividend? Revise the basics of AFM. Suppose face value of Reliance share is 100. So 10% of 100 will be 10 rupees as a fixed amount. Say yes or no. So if the dividend on underlying shares either given on fixed amount or on face value, it means that fixed amount is given. Okay. So in this particular case, the future dividend income you are going to get from fixed asset. First do PV for it. In formula where you see as the spot price or value of underlying share index, all of you guys have to do what? Subtract it from that. In formula, wherever value of S is coming, you have to subtract it, carry the net. Why we are doing this? The reason is very simple. Listen carefully. Why were we using this formula? Tell me quickly. Because we were saying that if I would have given you the money today, you would have invested and earned interest. So I am talking about compensating the opportunity loss. But you'll be thinking in this case, I told him that brother, if I had bought shares from you today, so the dividend that you will get after time of 2 months, I would have got it, not you. And I will buy this after 3 months from you. Right now you are taking dividend income. While I am compensating you for 3 months interest in future contract, I am compensating it, you can see in formula. And if you take that dividend income, it won't be good. The dividend income should be subtracted. When I am giving interest, I am talking about adding the interest. So my right should be on the income. I am compensating you. I am giving you the interest of 3 months, right? The income of that period should be mine, because if I had bought the share at 0 period, then I would have got that income. So subtract that too. I am paying for your opportunity loss, so you should pay for my opportunity loss, right? Why are we subtracting PV of dividend income only? Because that dividend income can also be obtained in the middle. Suppose you get the dividend on maturity after 3 months. So directly after calculating, you could have subtracted it. It can be done in any way, not necessarily this way. All teachers teach in different ways. That's why I told you to ignore what you have learned earlier. What institute is doing should be a common way in your mind. You have to ignore all scenarios. It's very simple. Whenever you are shared the dividend income in future, make it PV and subtract it from the spot. I will give an example so you can understand. How will you do the PV of the dividend? It is a simple interest. It will be explained in question. Same will go throughout question. How we do PV? You keep 1 plus R in the denominator. R into T. Okay, R is what? It is the rate per annum. And what is time? Give focus on time. T is number of days or month after which dividend income will be received. Okay. Consider time in which you will get the dividend income. Don't take future contract time. You are doing PV of the dividend income. If it is a continuous compounding interest, then it will be dividend income divided by e raised to the power RT. It can also be written as dividend income into e power of minus RT. I have told you this in basics of AFM in basic mathematics. If power of anything is negative, then if you want to make it positive, you have to reverse the base. The base will be in the denominator. If e raised to power RT is in denominator, then you can make it negative if you want to. Bring it in numerator. I have thoroughly explained it in regular batch, right? Sir, why you wrote 2 scenario? Both have same meaning, but do check the question. If you have been given value of e raised to power of RT, use this. And if you have been given value of e raised to the power of minus RT in your question, then use this one. Getting it or not? In detail, you can see in the batch. There I have explained it. See questions there. In monthly compounding interest, dividend income will be divided by 1 plus R to power T. Here time will be the number of months after which dividend will be received. It is very simple. Now look at another scenario. If dividend income underlying share or index is given in the question but given in yield percentage, it means dividend yield rate is given. What is meaning of dividend yield rate? Dividend on market price, not the face value. I explained you in basics. So if dividend is given in yield percentage, then all you have to do is, in formula where R is coming rate of interest, in that you have to subtract Y. Y means dividend yield rate. Keep doing R minus Y. Assume that interest rate is 10% and dividend yield rate is 6%. So you'll do 10 minus 6, understood? Now the third note which is coming in your mind. Which formula to use? You have 3 formulas. Simple interest, continuous compounding or monthly compounding. Which formula to use to calculate fair price in the future? It will be specifically mentioned in your question paper if it's simple, monthly compounding or continuous compounding. No worries. or it will give you a hint. For example, if in question compounding continuously interest rate is given, so it is clear that it wants continuous compounding from you. Is this clear or not? Or interest is given per month in question paper, like interest rate is 1% per month, or it says interest on monthly rest. For example, if it says interest rate is 10% per annum but interest will be charged on monthly rest. So in this case you guys have to do monthly compounding. Understood? Otherwise you all will simply use what? Simple interest. You have to follow this for exam. I always teach you concept and exam simultaneously. That goes in our notes as well. Now check this. What we have learned to calculate is theoretically or fair price of the future. In the market, the quoted trading price can be anything like, for example, there is a market of rupees 2500 in our example. Understand that share price and futures are two different products. For example, share of Reliance is different product and Reliance future is a different product. It has its own separate trading in the market on the first floor. As I told you earlier in the class, continuously going on as per demand and supply. The price changes time to time daily. Price can be anything, actual quoted of future. This is just a theoretical fair price. To do a transaction contract in market, it should be based on the quoted trading price. Next point, which is not that much important, is the contango and backwardation market situation. This is just a name for the basis, which is S minus F. S means spot price of underlying share and F means future price. So if the basis is positive, it means the market is backwardation. What is this? Let me explain. S means spot price of underlying asset minus F means future price. So the difference between underlying asset spot price and future price. If it is positive, then it means that the underlying asset spot price is high and the price may be low in the future. It means that the market is going down in backwardation. Similarly, if SF is negative, then it means that the underlying asset spot price is low and the future price is high. It means that the market is going upward in contango. Normally, you will get contango only in practical life. Example will give you much clarity on this topic. Consider a 3-month maturity future contract on A Limited. There is a future contract on A Limited share. The spot price of A Limited of underlying asset is 200 and face value is 10 and the continuous compounding rate is 10% per annum. You have to find the fair future price in 3 cases. The first case is if there is no dividend income expected on A Limited share. What will we do in that case? Value of E is given. In question you can take it. How did you calculate the future price? Sir, compounded. Continuously compounded interest rate is given. Use continuously compounded interest formula. Spot into e to power RT. Spot is 200 multiplied by e to power. Rate of interest is 10%, 0.10 into 10. Each value is given. You have to calculate. Secondly, if 25% dividend income is expected on A Limited share after period of 2 months. On A Limited share and after 2 months, you are expected to get a dividend income of 25%. Face value is 10. 25% of 10 is 2.5. Dividend is in fixed amount. Let's do PV of this dividend. So 2.5 divided by PV will be done on basis of continuous compounding. E raised to the power R 0.10 into time. Now you will get the dividend after 2 months. So multiply with 2 by 12. Now in the question we are given value of e raised to the power minus 0.01067. So we have multiplied it by 2.50. Okay. If I would have written this in denominator, then the answer would have been wrong. This part is mathematics and a bit logical. We have talked about it in batch, so no need to repeat. How will we calculate future price? Minus dividend from the spot price multiplied by E 0.10 into 3 by 12. Last scenario, if you have been given dividend yield, then wherever R will come, you have to subtract, means spot into e raised to the power R minus 0.06 into 3 by 12. Now it is solved. This was your topic on calculating fair price of the future. Next point in this pricing of forwards and future is price of one future contract or lot. What will be the price of one future contract or lot? Now sir, what is this? Listen very carefully. I went to the stock exchange and told them that I want to do betting on Reliance share. Yes, you heard me right. I want to do betting on Reliance share. The price will be more than 2500 after 3 months. Write it. Stock exchange guy asked how many shares you want to bet on. I said 1 share of Reliance. He said, I don't talk to small people like you. If you have a big heart and a lot of money, then come and do betting. Otherwise leave. I said, how much money? How much should I bet minimum? What should be minimum amount of contract? He said that the minimum lot size is of at least 50 shares, no less than that. That means you have to bet on at least 50 shares. You have to enter future contract on at least 50 shares. Getting it or not? If you want to bet and get contract, then you have to enter at least for 50 shares. This is called lot size. Lot means contract. Lot means contract. If you get the word contract or lot, both have the same meaning. Okay? So in any case, if I want to do a future contract, then it will be of at least 50 shares. This is what stock exchange guy told me about market. So if you have to find the price of one future contract, which you have to find in many questions, and many students make mistakes in this, I don't know what they think. So let's suppose the actual quoted trading price of futures is rupees 2500. Multiply it by the lot size, which is 50. This will be our price of one future contract. Okay? Now see, if the actual quoted trading price of future is given in the question, because in practical life this is used, and the price of one future contract is required, then assume that the theoretical or fair price of future is equal to the actual quoted price. Everyone understood? In such questions, assume that the theoretical or fair price of future is equal to the actual quoted price. Very good. Read question carefully. Many times actual quoted will be given and you calculated theoretical price. Which price do you take then? Sir, only the actual quoted one. But if the actual quoted price is not given in the question, then theoretical or fair price of future is considered as actual quoted. Lot size means number of shares or units in one contract. Okay, amount of shares you have to buy for one contract. Units means units for index, or number of times share delivered in one contract. If we get wording in question that 50 shares will be delivered in one contract, it means it is lot size. Or wordings like minimum trading lot or contract multiplier or trade multiple, whatever wording you get in this, it means lot size. It will tell you the quantity of one contract. After these, there is contract value. What is this? Now see, I told the stock exchange person that you are saying that the lot size is of 50 to do one contract. Okay? I said to him, make 4 contracts like this. Now listen to what I did. I said make 4 contracts. Pay attention to what I did. 2500. It is the price of one future of Reliance in the market. Multiply this by 50, lot size. If I want to enter into one contract, I'll have to pay this price. 2500 into 50 means 1,25,000. 1,25,000 is the price of one future contract. Say yes or no? Got it? Now what does contract value means? Contract value means the total amount of future contract that I have done, amount of future contract done, either buy or sell. Okay, so if I am doing contract to buy, then I did for how much amount? I told him to make 4 contracts like this. So he made 4 contracts and the price of one contract is 1,25,000. Total contract value is how much? Rupees 5 lakh. Total contract value is 5 lakh. I have entered a future contract of rupees 5 lakh, means I have done a new contract of rupees 5 lakhs. This is known as contract value. It means the amount of future contract made. Price of one future contract or one future lot can be anything. How much is the price of one contract multiplied by how many contracts or how many lots I have made. So you should have clarity in these things. Many students don't have clarity in these things and they ask wrong questions because of these things. Now you see this once. Now I will let you know where you make mistakes. I am giving you a scenario. If you understand this, then you will never make a mistake in the exam. Current Nifty value is rupees 24,000. Current Nifty future is 24,500. Lot size 50. Number of lots is 2. Current Nifty value is given to you rupees 24,000. What is this? It is the value of Nifty. Some people think that it is the price of future. No, it is not. It is the value of current Nifty. The spot price of the underlying asset is given. The underlying asset is Nifty and spot price of it is given. Current Nifty future, that means this Nifty future's current price, which is the actual quoted trading price of Nifty future in today's market for a single future. Did you understand? Lot size is 50. That means if I want to do one contract of Nifty future, then it will cost me rupees 24,500. One is the price of future and minimum is the lot size of 50. 50 is the price of future contract. So number of lots, if I am taking 2 lots, then it means that if this is my price of one future contract, then total how much amount should I contract in? So amount of this one multiplied it by 2. That means I am doing a total contract of this much amount future contract. Only this much amount. You should have full clarity in these, then you will never make a mistake in your questions. With this, your pricing of formats and the futures is completed and your very basic concepts is now clear to you. Now let's move ahead in this topic only. Now the next topic is here. We can have a look on this. You will not face any difficulties. Now you all see this? Gain, loss or payoff on future contracts. How to calculate gain, loss or payoffs on future contracts? I entered into a future contract that I will buy Reliance share after 3 months for rupees 2500. Here I am talking about upside betting. On maturity we have to do settlement, that we do it by cash. That only we have to find. How much is gain or loss on future contract? Like we signed future contract on maturity, which we call payoff. So question is, payoff or gain loss is the same thing. Gain loss or payoff, that means doing settlement. Future contract settlement, which we do in cash. How is it calculated? Future contract is calculated by squaring off on maturity. What is squaring off? What you have to do is, look, this word is not of any use, but I wrote it because many times it mentions in the question. You will think that what wording is coming, this is very special technical wording. Sir has not taught. You know who make this chapter tough? Everyone in market. They deliberately tell you such technical words and excite you. See what else things are there? You do not know anything. Forcibly make this chapter tough. There is no meaning of square off. Square off means cutting the contract, ending it. You do settlement. Settlement in cash on the day of maturity by cutting contract and ending settlement in cash. That's it. This is the thing that means this word does not have any special meaning. Did you understand? So you have to settle the contract on maturity. Calculate gain, loss and payoff. For that only we worked. We entered the contract so that maturity can gain or loss. How will it come? It is very much easy. I have already explained it to you. Till now we have done this only. I have written it here. See, initially if I have taken a long position in the future contract. Sir, what is this long position? If you have revised the lectures in sequence wise, I taught in portfolio long position means to buy something and short position means to sell something. So long position means buying futures. What does it mean to buy futures? I buy the futures. It means that I have bought a contract to buy in the future. What is the meaning of contract 2? It is upside betting. I have now explained everything. So I am not going to explain it again. Contract to buy means I have done upside betting, which means I have to gain when the price increases. I will gain if price increases. So in this case, if the price increases on maturity, then what will happen to me? Gain, and if it falls, it's loss. This much simple topic it was. And in exam, you will have to do this question and calculation. Second scenario, if I had created a short position in the future initially, that means I sold the future contract to sell. Contract to sell means downside betting. I had put a bet on the price to fall. So what happened to me when the price fall? I had to gain. So in this case, if the price of the future falls on the maturity, then there will be a gain, and if the price increases, then there will be a loss. So how can we calculate the amount? I have already told you about the gain and the loss. Now tell the calculation of the amount. There is no specific formula that you will get in module. I have drawn and given you the crux. What all scenario can be there, we will look. You will get the paragraph in the module and nothing more than this you will get. How will you get gain loss on future contracts? Simple formula that you were doing till now, number of contracts or lots. How many contracts have you done? How many contracts have you done? For example, I was doing 4 contracts. How much was the lot size of one contract? Sir, it was only 50. In one contract, it was on 50 quantity. So 4 into 50, that means how much? 200. I was betting on 200 shares. It means that if you want to get gain loss, then you will have to calculate that on 200 shares. Number of contracts into lot size. Multiply by what? What's gain loss and difference in price? Initially, contract was done as contract to buy at 2500. After 3 months means upside betting. After 3 months, price in market was rupees 2600. I made 100 rupees profit on single share. How much I made a contract? I have made 4 contracts of a lot size 50, meaning 200 shares. 4 into 50 meaning 100 rupees profit per share. How did we calculate the per share profit? Difference between price of future on maturity settlement price and initially contracted price. So what is the difference between price of future on maturity settlement and at which price initial contracted was done? This was very simple. This formula is not derived. It's a logical formula. You remember this, that's why I showed you. So how will you know the amount, whether is it gain or loss? It will never be known from the formula. It will be known from the chart. So you always keep it in mind that whenever you take out the gain and loss in the future, you will get to know the gain and loss from this chart. Then you will calculate the amount. Rest of the things, first we find the amount and then we see if it's gain or loss. Here we will get to know from the chart whether it is gain or loss, and then we will decide what is the amount. After this, another scenario, one more formula to find gain or loss. Contract value into rise fall percentage in price of future on maturity. Sir, why these 2 formulas? There are no 2 formulas. You must understand the question. Suppose in exam you were asked to find gain loss on future contract, but they didn't tell you what is the price of future on maturity. So where will you get the gain and loss from? You know what was contract to buy upside betting at 2500, 4 contract at 50 lot size. Okay, but what is the price on maturity now? Is it possible that they have forgot to mention the price on maturity in future? No, it is never possible. You have to think and look carefully. What will it get? It might say on maturity, future price rises by 2%. Do you know what this means? It says during maturity, the price of the future has increased by 2%. Price has increased by 2%. Do you understand the meaning of rise and fall? You can get any other wording, but don't get strict on it. The price of future has increased by more than 2%. I bought contract with upside betting at rupees 2500. It is increased by 2%. That means it is profit. See how profit will come? Look at contract value for contracts. Lot size of 50. Multiplied by what is the price of one future? It was 2500. How much amount came? 5 lakhs in the example we took. So I contracted a future of rupees 5 lakh. Contract to buy in price of 5 lakhs. Are you understanding? If it has increased by 2%, do the 2% of rupees 5 lakhs directly. This is my gain. Contract value into rise fall percentage in price of future on maturity is easy. If in percentage it is showing like this, then multiply it by this. Otherwise it is logical and nothing special. Example is written here. You can see and read on 1st January Nifty future. 3 months traded at 30,000. That means price of Nifty future. One lot of Nifty future consists of 50 units, means lot size. Mr. A took a long position on 2 lots on Nifty future. That means contract to buy upside betting. Is it clear? Now you will have to calculate gain loss. First case, price of Nifty future after 3 months is rupees 21,000. Number of contract is 2. Lot size is 50. Multiply by difference between initial 22,000 minus 21. Is it gain or loss? I took long position, so it will beneficial if price increases. It increased to 21,000. Second scenario, price rises by 5%, so calculate the contract value. What is the price of one contract? What is the contract value? This multiplied by number of contract 2. So this I have done. I have directly done it at once. Once it is in your mind, then you will be able to do it directly. Multiply by price is rising by 5%, so it is gain because of upside betting. Next scenario, if Nifty future falls, then there will be a loss. The calculation is same like this. Topic is complete and it is the most important, which usually asked in exam. Now let's see types of margin in future contracts. In future contracts, there are some margins which you have to understand. What is this? See, in the case of future, what is the concept of margin? I will explain the concept of margin in the case of future contracts with the help of an example. Stock exchange. This works as intermediary and it helps in the betting. So Mr. A came one day and said that he wants to do upside betting on Reliance, share at the price of rupees 2500, and Mr. B wants to do downside betting on the same price. After 3 months, the market was priced at rupees 2400. So this was the price. So what happens now? Mr. A had made a bet that price will increase, but price decreased. He had loss of 100. Mr. B did downside betting and got profit of 100. So now Mr. B went to the stock exchange and said that he did the downside betting and he got a profit of rupees 100. Give me. Then stock exchange said, why not? You gain a profit. So once the other party who had loss of rupees 100, I will ask for rupees 100 and give it to you as I am an intermediary. Mr. A said, definitely you ask. So stock exchange called Mr. A for payment. You give money, that is why he is calling. So when Mr. A got the phone call in the stock exchange, but his phone is switched off now. Dialing after 10 minutes again, it's coming switched off. It's been 2 hours, 4 hours, 2 days, 4 days, 8 days, 10 days. The phone of Mr. A has never been switched off before. Now the stock exchange is in tension. Mr. A has got a loss, and what if he might have fled? So the stock exchanger has immediately sent his employee to go to Mr. A's house and ask him to give 100 rupees so that we can give the 100 rupees to Mr. B. So his employee went to Mr. A's house and found that Mr. A has sold his house. There is nothing in his house. He found that it's been sold to someone else. Mr. A has escaped because he had a loss. Now stock exchange says to Mr. B that, look sir, you have gained, but the other party who had a loss has now ran away. So we couldn't recover the loss from him. So how can we give you the gain? So now Mr. B has become very angry. Mr. B says that I told you that price will fall and it fell, so I want my gain. I don't know who the other party is. I came to you. You are an intermediary and for which I paid you the commission. You should take care of this. You never made me to meet the other party. I do not know anything. There is a profit in the major downside betting. Give me the profit or else I will create riots. Stock exchange says to keep calm and do not create riots. Take profit of ₹100 from me. Mr. B is happy that he took profit and Mr. A is also happy that he ran away. But here stock exchange started crying. Why? Because there was no role of his, then also he had loss. He was sitting for the commission, he was not betting, then also he bear the loss of Mr. A. Why? Because he has trusted both the parties. So in today's era, we cannot trust anyone. Okay, trustworthy people are special people. You must be knowing that there is a dialogue in the web series. You must be knowing that we should not comment on that here. We should not trust anyone. The poor stock exchange is now regretting by trusting them. So the trust that stock exchange has given has broken his heart very badly. He has taken an oath from now onwards. What oath has he taken from now onwards? If anyone comes to him for the future contract betting, will come for the future contract, then I will first ask them to submit a security deposit. Before that, I will deposit the security deposit, that means the margin. We will call security deposit as a margin. I will deposit the margin so that in case of loss, if they run away, I don't have to worry. I will take this much amount of security deposit. So you must have heard the saying that one who gets betrayed once, he checks twice before trusting on anyone. That is what stock exchange will do now. So this is the concept of margin in the case of the stock exchange. This is also different thing compared to the forward contract, which it's not there in the forward contract, which it's margin. Now there are three types of margins. The one is initial margin. Initial margin is the security deposit. Initial margin means the initial amount which the investor deposits to the stock exchange in the margin account to enter into a future contract. If any party wants to enter into a future contract, then the stock exchange will tell him to take this box and put on initial security deposit amount in it. Stock exchange will take bank box and stand. They will tell Mr. A to deposit the security deposit in this box, that is initial margin, and then he will give another box to Mr. B and he will put money. This money does not belong to stock exchange. On maturity, it will add profit to the margin, and if it is a loss, then it will take out from margin and net amount will be refunded. It is not for stock exchange, it is for security purpose. It will open margin account. It will open the margin account. In practical life, it will be in digital form in platform of the broker. If I have deposited the margin, then it will show my margin statement, how much money is there, plus or minus, whatever it is. I think it will be shown in digital form of the Mr. B, so he opens everyone's personal margin account and deposits money in it. Stock exchange make the money to deposit in it. So how to calculate the initial margin amount? It is very easy. In the question, it will tell you that the initial margin is 10% of contract value. How much? 10% only it will tell you, simply do it. In practical life, it is generally around 10 to 15%, else whatever is written in question. Write that. After this, I wrote one more formula, mu plus 3 standard deviation. Why are you writing two formulas? It depends on the question. In question, you don't know how much percent of contract value is initial margin and you are asked about initial margin. So understand that such data will be given, that this formula will have to be applied. It will depend on the data of the question, which formula to apply. Don't start asking which one should we apply. Follow as directed. You can't even do plus minus 0.1% in my notes. You will not say that sir has not told this. All that is inbuilt in it. If I haven't written anything here, it means that it will depend on the question, what data is given in the question. The notes that I am giving you are made with lot of hard work. That is why people are copying and pasting these notes in the market. Every teacher, whoever is new, comes and stand here and take this note and start teaching by his or her names. This is what happens here. But what to do, leave them and you focus on studying it. So this is mu plus 3 standard deviation. Mu plus 3 standard deviation. What is this formula? Mu means average daily absolute change amount in contract value. And standard division is standard division in average daily absolute change amount. What are these? See example. See contract is of rupees 2500. Mr. A is saying that it is upside betting and Mr. B is saying that it is downside betting. He is putting money in the stock exchange in margin account. He is saying that margin is 10% of contract value if we calculate contract. Lot size is 100 and contracts is 4. The price of one contract multiplied with number of contracts, the contract value is 10. So he got the initial margin of 1 lakh. This is the normal way. Now see the second way. I have told you about this way, but the stock exchange would also be calculating, right? I am telling you the same way, which is given many times in question. Stock exchange sees that if we do a contract of rupees 10 lakh, then how much change can happen in that amount of rupees 10 lakh on a daily basis based on past experience. How much change can happen on a daily basis? Stock exchange has seen that on an average. Rupees 70,000 can be changed of the contract value. On a daily basis, it may be due to gain or loss. I will further tell you why we are watching changes of daily. Pay attention. See, the stock exchange has to see that will there be gain or loss. For this 10 lakhs contract that is made, we have to see that what can be changed in value of rupees 10 lakh on which the contract was made. So they saw on an average, because of past experience, there can be a change of rupees 70,000. So it is called mu. In the language of statistics, mu means mean average. Plus they will ask for this amount which can be changed. And if this drastic change can happen, then they will get it deposited in advance. This was an average change. There can be a deviation also. We have seen from past data that there can be deviation of 10,000. It means parties can suffer loss of 60,000 or 80,000 as well on any given day. Right now we are interested in 80,001. Yes or no? Because stock exchange wants to be completely safe. So stock exchange is thinking that on an average there can be a change of rupees 70,000. Plus deviation is rupees 10,000. Sometimes it can reach 80,000. Do you know how much deviation it will ask for? It is asking for 3 times of deviation. Yes. It said that on an average on daily basis, a person can have loss of rupees 70,000 on a contract on an average. Stock exchange has deviation of rupees 10,000 and loss can be of 80,000. Stock exchange is asking for security deposit equal to average change and 3 times of the average deviation, as it is the initial margin. Mu plus 3 times of the standard deviation. Keep this in mind. We will not talk in detail as we did in regular batch during revision. We'll keep it brief. Mu plus 3 standard deviation is the initial margin that it deposits. Let's see mark to market margin. What is mark to market margin? From this you will understand why we were taking the daily change. Mark to market margin means amount of gain loss arising due to daily settlement of future contract. Stock exchange daily settles the future contract. Future contract has this one more special feature. Future contract has this daily settlement feature which is not found there in the forward contract. There is no margin security deposit in forward contract because there are 2 parties involved. And like this, in future contract also there is a daily settlement feature. Stock exchange settles the future contract daily and gives gains to the parties daily. The one who gains gets the gains and the one who is losing, exchange takes money from his account. The margin account is adjusted accordingly, whoever gained or lost. This is how it works daily. So it settles the gain and loss in the margin account on a daily basis. How it works? On daily basis. Gain loss is calculated on daily basis. What does it mean? This is the reason why we were taking daily changes. According to today's settlement, the stock exchange runs on the safer side. I will tell you later on any time how it runs on the safer side. Now let's understand mark to market margin a bit, right? Do you know daily settlement means that any party can leave the contract anytime. Mr. A has contacted for upside betting and Mr. B for downside betting at rupees 2,500. Upside betting, downside betting, lot size is 100, contract is 4, contract value 10 lakh, initial margin 10%, 1 lakh. This is data given to you. So Mr. A opened the margin account and deposited 1 lakh. Mr. B was asked same. What happened next? The contract was done at total price of rupees 2,500. Now, as it settles daily, next day price increased to 2520. Price increased. Mr. A gained because he did upside betting and Mr. B lost because he did downside betting. How much number of contracts, lot size and difference between the initial price and today's price settlement. See, it's nothing special in calculating the gain and loss. Settlement simply means calculating the gain loss. Are you getting this? Now they will calculate gains and loss on a daily basis and they will do settlement accordingly. The margin account will be adjusted with rupees 8,000 in Mr. A and Mr. B's account. Similarly, on the second day, the money increased to rupees 2,550, increased more. Again, Mr. A gained, it was 2,520, but now became 2,550. So number of contracts into lot size. Now you guys can simply perform the calculation. Just don't make this mistake that don't take the difference from the initial contract date. You have already done the initial contract date difference with the previous day. Daily settlement is going on. You have to calculate between first day to second day. Do settlement of these prices. You have already done the previous settlement, right? Now you have to do settlement calculation for this one. It means 30 rupees was today's gain per share. So Mr. A gained 12,000 and the accounts were settled accordingly by the stock exchange. Okay, so in today's time, Mr. A has rupees 1,20,000 in his margin account. For Mr. B, 80,000. If Mr. A thinks he has gained sufficiently, then he can walk away by cancelling the contract he was in. Cancelling is allowed in future contract. There is no problem. Sir, what will happen to B? Mr. B can play further if he wants, because the stock exchange will bring another party. It does not expose who is the next party. If he wants, he can play. This is a special feature of future contract. Anyway, daily gain loss will be calculated and daily settlement will be done. Nothing is special. Market margin means gain loss on daily settlement. Number of contracts into lot size into difference between closing future price of today and closing future price of previous day. What's the future price of today and what was the future price of the previous day? The difference between these two, because the previous day's price previously was already settled. So you see the differences in daily prices. You can also understand it like this, that Mr. A said upside betting at rupees 5 and Mr. B said downside betting. On first day it's 22,520, then Mr. A has won and Mr. B has lost. First day is settled. What will happen on second day? The price is 2550. Then it will be assumed first day is settled. It will be thought when price was 2520 on the end of first day, Mr. A had said upside betting and Mr. B downside betting. Gain loss of these two price difference. So this way also you can understand logically, as I have verified it through lecture. After that comes maintenance margin. This is third type of margin. Maintenance margin means when the money goes below the maintenance margin in the investor's margin account. The stock exchange calls the investor and says that the money has gone below the maintenance margin. He can restore the money in the margin account so that it becomes equal to the initial margin. Means it plays very safely. See how it works? Exchange says maintenance margin is 75% of initial margin. Initially 1 lakh, so it comes to 75,000. Third day it was 2570 price in the market. It has increased. Mr. A is benefited. 2570, last day it was 2570. We will continue with last because earlier one was settled. Mr. A got benefit of rupees 8,000. So Mr. A has 128 in his account. Mr. B has a loss of rupees 8,000. So his account now has rupees 72,000 below margin account. Margin is 75,000. If it comes below margin, then the stock exchange will call and say that money in your account is below margin. It is 72,000 below the maintenance margin. Restore it to the initial margin. That means make it 1 lakh again. That means at 28,000. So that it becomes 1 lakh today. Otherwise, I will cancel your contract today and you will have to go out. You won't be able to play betting in the future. Now the stock market runs on a complete safe side. It was betrayed. Did you understand? So it has made the call of 28,000. Now if he wants, he can continue to play. Did you understand? So only this was left in it. So how will we get maintenance margin? Maintenance margin, initial margins percentage or percentage of the contract value will be given in the question. I have given a format in this. Format for a statement showing daily balances in margin account and call money. This will be asked many times in the question. How will they say? How much daily balance is left in margin account? How much call money was asked and on which date? So for that, make a statement of total 6 columns. Keep this format in mind so that you will get all your calculations and marks. First column is the date. Second column is opening balance in the margin account. Initial on first date. Then on every date, mark to market margin or gain loss on daily settlement. For gain, margin account gets plus else minus. What will be the fourth column? How much balance is left in the account after adjusting the net market margin? That is second column plus or minus third column. After this, the fifth column will be of call money. When will the amount come in this? When in the fourth column, after adjusting the mark to market margin, the amount left has gone below the maintenance margin, then call money will be ordered. It's listed in the fifth column if it is below the maintenance margin, and sixth column is closing balance amount left in the margin account. Column number 4 plus if you have asked for call money, then add that it is closing balance. Look at the example. On 1st January, Nifty future is trading 20,000 for 3 months. Lot size is 50. Has taken long position and done to contract and lots. Find gain loss of Mr. A. 3 dates are given to see Nifty future price. Initial margin 5% of contract value and maintenance margin 90% of initial margin. Make a statement of daily balances in margin account. So find out contract value, initial margin, maintenance margin. Now you can clearly see the statement here. How much is the opening balance margin in the account? 1 lakh. Initial margin in the start? Nothing on first day. It became 1 lakh. 2nd January, the price is 20,050. Long position speculation on 20,000 in upside betting. I have calculated the gain in the third column based on price difference. So the balance is 1 lakh 5,000. Call money not required because maintenance margin is 90,000. So the closing balance is 1.50 lakh. Look at 3rd January. On 3rd January, the price fell from 20,050 to 19,850, meaning it was loss. Found loss by reducing 19,850 from 20,050. Loss removed from 1,05,000 becomes 85,000. So see, maintenance margin is 90,000. Now call money will be called. Rupees 15,000, it will be restored till initial margin. Till initial margin, 1 lakh closing balance is done, the next is opening. And now the price is 20,200. Gain came from here to here. We put gain 135, balance will be complete. Very easy to make a statement. Now see how much Mr. A has gained here. Let's assume Mr. A has 3 days of contract. So what's gain? Assume total 3 days of contract. So there are 3 ways to get gain. I mean total gain. I have taught you one thing. What have I taught? I will teach you how to verify the daily settlement of the gain coming. And overall, if we found out the gain loss of maturity, then it would be the same gain loss and no difference. Number of contracts into load size into difference between initial contracted and final maturity settlement price. 20,200 price of maturity. Initial price 20,000, price increased on maturity. Means gain. See difference of both prices. 2 into 50 into 2,200 minus 20,000, gain is 20,000. Did you understand? Now see the daily settlement gain. Do total of 3rd column, gain 5,000, lost 20,000, gain 35,000. Total will be 20,000. Column 3 total mark to market margin. There is another way to get gain and loss. Margin account closing balance is 1,25,000. Opening balance was 1 lakh. We added another 15,000 call money. So in the end it is 35,000. We gave 1 lakh earlier and added 15,000. So net margin is increased by 20,000. You get gain. So when you get a question of this type, gain loss is calculated in 3 ways. One is traditional. So it is also matched as final price and starting price. The concept is now clear. You can total the mark to market margin of column 3, or what is the margin account balance at the end. Subtract the initial margin and you will get it. With this, your whole topic is complete. Types of margins. Now come to the next topic, hedging using futures. Check the next topic in forwards and futures. Very important topic. The topic is forwards and futures. You get questions from this. Students generally make mistakes in this topic. It will be very easy. If you follow this step by step, and we have done also all the questions step by step. Evaluate in a good way. So now we will revise this properly. Now see this topic. Are you able to see? See this now. Hedging using futures. What is hedging? What does it mean? It means reducing your risk. I have a share of Reliance and I am afraid that the price will fall after 3 months, so I can't sell it today. The reason is that the income tax will increase and it will be exempted after. So will we do the contract of selling after 3 months? Do the downside betting. Price falls, it's gain. And if the price falls, then there will be a loss. So it will recover from there. So you will not face any problem. The only loss for the hedger is that it never gets the benefit of favorable movement. What is this? I will explain. First of all, hedging using respective share futures. Hedging using respective share futures. This is the first part only. This is useless for the exam. This is a useless exercise. It doesn't make sense to make any question from this. But still, take the respective share futures and hedge them. That means the share with which you will hedge, find that share in future market. On the ground floor of future market, I bought Reliance's share in cash market. Cash market. What is in the first floor? Derivative futures market. So now I came to the ground floor. I am scared of that price will drop after 3 months. So what will I do going to the future market? Will do future contract. What is the fear of future contract? That the price in future will fall. Do what you are afraid of, bet on what you are afraid of. That means to do downside betting. Basically doing what are you wholly afraid of. There are many famous songs in movies. There was a song in the movie that I will do what I am afraid of. What is the fear? The fear is that the price will fall after 3 months. Price will fall after 3 months. So do downside betting on this. That the price will fall after 3 months. Did you get it? That means I am going to work on this. So you find the respective future of the share you are investing in. So find the future of Reliance's share. If you want to do hedging on Tata's share, then find the future of Tata's share. That means find the future of the share which you want to hedge. Have you understood this wholly? Then sir, how will we do it? It is very easy. Long position on the company's shares means you have bought the shares in the cash market. So what to do in the future? In this case, you will be afraid of the price falling. You will not be afraid of the price increasing but price falling. So any downside betting means short position in future, means selling the future contract. But if there is a short position in cash market means short selling the shares I explained you in portfolio. Keep revising your material. Short sell means I bought the shares on loan and sold them. Later when the price will go down, I will buy it again and return it. Understood? Now I am afraid of short selling because the price of the future and share might increase later. If the price increases later, it will be a loss because I have to buy more and return it. So what are you afraid of when you short sell? Price increasing. So the fear is about upside betting, which is a long position on the share future. So on the share future of this company, long position, buy the contract to buy the share future. That means the position in the cash market. Its reverse position, the ultimate crux, the position in the cash market, do the reverse position, share futures. It will be your proper hedging. Your proper hedging will be done. Proper hedging. And there will be no problem. And you can remember it conceptually. Do what you are afraid of. If you are afraid of price increasing, then do upside betting. If you are afraid of decreasing, then do down betting. This is just an example. You can see for yourself. Have you understood? I have bought a share of rupees 2500. Now I am afraid that the price will fall. I will go to the derivative market and I will do downside betting on Reliance's share futures of 2500. In today's price, I will contact to sell it after 3 months. Price at maturity is 2400. The share was of 2500. As it become 2400, losses of rupees 100. On futures, we did downside betting from 2500 to 2400 with 100 rupee gain. And I am hedged ultimately. Okay, share as much as the future is. And if the price would have been 2600, then it would have been a gain on share. But in future, there was downside betting, so here is the loss of 100. Ultimately, I came to nil. That means due to performing hedging, I am saying unfavorable, not downside. I was talking about the unfavorable because it depends on the contract. Unfavorable movement will give you protection, but favorable movement will not give you benefit. I was afraid that price will fall, but I got protection. But when the price increased to rupees 2600 in the market, the favorable moment has also gone offset. Okay, favorable moment has also gone offset. I can't take advantage of the favorable moment. So people do hedging because a hedger is a cowardly person. He does it because he wants peace of mind. He wants to sell in rupees 2500, just that it sells at 2500. I don't want the increased price in the market, don't want a gain. But I don't want loss either. Hedger is such kind of a person. He wants to sleep peacefully. He is not very greedy. He wants to sleep peacefully. Did you get it? So these are all share features used in hedging. So this is not very useful for the exam. Now the second point here is how to use in-depth futures for hedging. Okay? Hedging using index futures. How we are going to do hedging using index futures? Let's understand that. Now what are these index futures? What are index futures? If you are having this doubt, then you haven't understood anything. Index future means future contract in which underlying asset is index. Index means market, Nifty, Sensex. Nifty, Sensex, market, these are all called index. Understood? Index future is future contract where underlying asset is index. So we have to use them for hedging. Sir, why will we use them for hedging? Sir, we might use them for hedging where we have bought Nifty in our cash market, where long position is on index. We will do short on index future. Is it like that? So if you are thinking like this, then it is absolutely wrong. You can never buy and sell index in cash market. Can Nifty Census be bought and sold? No. You can't take position in cash market. Only derivatives and future of contract betting can be there. Are you getting it? So sir, why are we taking index futures in use for hedging? See where it is taken into use. Listen carefully. They are used. It is very important. It is taken in use to hedge your portfolio of shares. Suppose I have invested in multiple companies in cash market like in Reliance, in Tata, in Birla, in XYZ. Has all these companies made so many portfolios? Suppose I have an investment of 1 lakh in the cash market of different companies. I am afraid that after 3 months, the value of my portfolio will fall. I am scared. I am afraid that it will be sold and that's why it can't be sold. Do hedging. But sir, how can I do hedging? I have so many shares in my portfolio. All companies share, then look for the share future. Find the share future of the second and then the third company. By the time I do hedging, it will be 3 months. Understood? Because in practical life, people have thousands of shares in their portfolio. Not possible? This is clearly not possible. So what should be done in this case? So in this case, you have to hedge the portfolio of shares in index futures. You have to contract on index futures. Index means markets, Nifty or Sensex. I will say Nifty. Are you getting it? Sensex and everything is included in it. So contract on Nifty's future. Portfolio will be hedged. Nifty means the market. What is my portfolio? Investment in multiple companies' shares. These shares belongs to the market. And what is Nifty representing? Representing the market only. Are you getting it? So using index and indexes future contracts, you can hedge your portfolio. Simple. That's why it comes to use. 90% of the students don't know why they are doing this. That's why there are index futures questions and why are they doing it. They just read the topic and then they say that we have learned from more knowledgeable teachers. They have more knowledge than you, so we have learned from there. Even though they don't know what their teacher has taught them. Understood? See the next point. To index futures. Why are they taken for hedge? For portfolio of shares. Second, to hedge the shares of such companies whose share future is not available in the market. Suppose I have bought a share of XYZ company and I am afraid that the price will fall after 3 months, so create a short position in the future. I went to stock exchange and asked them for trading share of XYZ future. But I went to stock exchange and asked them to trade the share future and they said we don't do betting on inferior people. I don't do gambling on inferior people. Okay, so keep in mind that stock exchange. Never make share futures available on all the company's shares. Only the share futures of big companies are available in the market. This is a common practice. Who will look at small companies that people don't know about? Who will bet on them if they are small company? I will give you a simple example which I gave you in the class 2. Suppose there is a cricket match. So in every street, every kid knows that there is a match. And in every street, in every house, someone must be betting, someone must be gambling. They may be doing it for time pass, but everyone will be betting. Take it as a major. But let's assume that there is a match between Ireland and Netherlands. I can guarantee you that people don't even know that there is such a match of these countries going on in cricket. Those who don't know about it clearly don't have a stake or any reason to know that such a match is happening. Then why will they bother to bet or gamble on those companies? Have you understood? Did you get it? They won't do betting on it. So if a few people come to do betting on it, then the stock exchange denies that betting cannot be done. So how can I hedge a company whose share is not available in the future? Sir, you can do it from the index future. This share is also a part of the market. You can hedge it from the future of the market. It is important to understand how. How to use index futures and how to do hedging, there are total 4 steps. I am going to tell you these 4 steps. Store that in your brain. Nothing will go wrong if you do all the questions stepwise that I made you do in the class. And if you revise them sincerely. The rest of the students have to follow and solve them and check later. See how you will work in this process. Look carefully. In exam, many questions. Sometimes they ask for calculation of only 2 steps. Sometimes they ask 3 steps. Sometimes they ask calculation of total 4 steps. So it is not necessary that you have to do total 4 steps in every question. Who has asked? Which position should we create in the index future? The same I told you now. Shares portfolio in cash market. Shares portfolio in the cash market. Okay, respective such shares of a company whose future is not available. We can talk about this, but no questions come on this. It is mainly in the name of shares portfolio. Try to understand. So I will say the word which includes the share of a normal company which has no share future. I will say share portfolio. So in the cash market, the shares have taken a long position in the portfolio. They have bought shares of many. Fear will be there. So what will we do? Short position sell index futures. Similarly, in the cash market, the shares of companies have been short sold, a short position. We will create long position and buy index future. Did you get it? Most of the questions are according to the long position. In short position, a few questions come by mixing. So we will take the long position scenario in our mind and I will make you work through this example. Step number 2, how many index future contracts should I buy or sell? How many to buy or sell? I have decided that I will buy future contracts upside or downside betting. Now how many total index future contracts should I do? How many numbers should I do? Sir, you didn't tell all these steps when we were working on respective share work. There was no need of numbers. If there is one share of Reliance, then we will do future on one share. If 2 shares, then 2 shares. Then what is the problem here? If there is a long position in my shares portfolio of 1 lakh, create a short position of 1 lakh rupees. It will be hedged. You can do it on the same amount. We can't do this. To understand number of index future contracts, how many numbers of future contracts should we do? You can do for the same amount of hedging. You can do it. I can even give proof. But I will tell you a little bit quickly, not much detail in this. There is a portfolio of 1 lakh. So if I short the index of 1 lakh, then what will happen? Look at maturity. If index falls by 10%, then I have shorted the downside betting, means gain. 1 lakh's 10%, that is gain of 10,000. Portfolio is of 1 lakh. On maturity, portfolio fell by 15%. Portfolio fell 15%. 15% of 1 lakh is in the cash market, then loss. Brother, it is a fall of the value 15,000, then it is a loss, right? Where is the net hedging? It is a gain of 10,000 and loss of 15,000. It is hedging when it comes around nil, when it becomes nil. Where is my hedging? It did not happen. Why it didn't happen? It didn't happen because index futures is representing entire Nifty and the entire market, but the portfolio is representing the companies which I have invested in. So the change that comes in the market, it is not necessary that my portfolio will change that much. This is a basic thing we have discussed. Portfolio fell 15% and index future 10%. If they fall from same percent, it would be fine, but they fall or rise from different percentage, anything can happen. Sir, this can never be a hedging. It can find a link between portfolio and index. Is there a link between portfolio and market? There is a link which we call beta. We have read in the portfolio chapter. It is very important. What does beta tell us? It tells us the change in security or portfolio in respect to change in market. If there is a change of 1% in the market, then what will be the change in our security or portfolio? Understood. 1% change in the market. How much times change in portfolio? If beta of portfolio is 1.5, it means if market falls by 1%, portfolio will fall by 1.5%. If the market increases by 1%, then portfolio will increase by 1.5%. Now you know how to do hedging when you do it with index futures. Now use beta. If portfolio has a long position of 1 lakh rupees, then how much to do index future contract? 1 lakh multiplied by beta. 1 lakh into 1.5 in our example, 1 lakh 50,000. Let me verify it. Hedging is happening. Verify it. After 3 months, the index fell by 10%. Index future contract of 1 lakh 50,000 fell 10%. Profit was 15,000. How much change? If market falls by 10%, then portfolio will fall by 1.5 times. Basically by 15%. 15% is coming. So portfolio was only of rupees 1 lakh. Loss of 15% means loss of 15,000. So in the future, gain is of 15,000 and in portfolio, loss of 15,000. Ultimately, it is nil. So how much amount will you have to do for hedging? Hedging with index futures. Value of shares portfolio multiplied by existing data of shares portfolio. This will be your amount. Got the amount. Now number of future contracts should I do? We have to do so that the value of future contract comes out. Total value of future contract. I have to divide the value of future contract by the price of one index future contract. Okay. Remember the formula of contract value, price of one future contract multiplied by number of contracts, which is contract value divided by price of one future contract. This is the amount of future contract. Try to get the reason behind all these things. You don't have to remember anything. Everything is logic. That's it. That's all. I thought the price will fall on maturity. But if price increases, there will be hedging. Won't get benefit of favorable movement. Index increased by 10%. That is loss. because I have done downside betting, loss was of rupees 15,000. Portfolio increased by 15% because beta is 1.5, right? So the gain on the portfolio is 15% of 1 lakh, meaning 15,000. But in the future contract, if there is a loss, then the net is nil. The hedging is done. So when you do hedging, you are saved in the unfavorable moment, but you do not get the benefit of the favorable moment. The helpless hedger doesn't want favorable moment, but he doesn't want fear either. He wants to sleep peacefully. So I have told you this much. This can give you a point in your mind which will help you in the next step. One thing which will help you the next step. Understood? The conclusion can be arrived. What hedging means? Hedging means that if we look at the overall gain loss on maturity, then it should be zero, it should be nil. This is the conclusion. Let me tell you that if you have drawn this conclusion, then it is wrong, because you are not able to think in detail, and it will be useful in the third step, because in the third step I will teach you to draw the overall gain loss on maturity. And when I teach third step, then many people often say that it should be zero. Now I will tell you that it is not necessary to have an overall gain loss on maturity zero. This is not necessary at all. Why? Now listen, this is the example. So let's say the index fall by 10% on maturity. Downside betting is 1,50,000, 10%, 15,000. How much did my portfolio fall in maturity? It fell by 14%. Why? Index fell 10%. Beta is 1.5, so it should fall by 15%. Oh my brother, we take out beta on the basis of past experience in the portfolio. We think that beta is this much. That means there will be this much time change in comparison to the market. But it is not necessary that the market move as we have thought. The market runs itself. If someone can accurately and successfully predict the market, then hedging is not required, right? There was no need of all this. People would have earned profit without loss. The market can go anywhere. The portfolio has fallen by 14%. Not necessary that things should work as beta says. So the loss is 14,000 and 15,000 gain in index future. So overall net, after doing hedging, we get 1,000 net total gain. Can we get gain after hedging? Yes, you can. Look at one more scenario. Index has fallen by 10% on maturity and it has gained 15,000 on downside betting. Portfolio fell by 20% on maturity. Yes, anything can happen. Market can go anywhere. Beta can't work as we think. So 20,000 loss in portfolio. So what is net overall? 5,000 loss. Sir, even after hedging, can there be a loss? Of course, there can be a loss. It is not necessary to not have gain loss in hedging. It can go anywhere in the market actually. Did you understand? Just store it in your brain and you will not face a problem. How to get number of index future contract? Value of shares portfolio into existing beta divided by price of one future contract. Sir, so you are missing one thing in the formula. In the existing beta, you have written minus required beta of portfolio. What is that? The required beta of portfolio is not given generally in the question, and we assume that it is zero in that case. So if you assume zero, nothing will happen. This is normal scenario. If I assume zero, then it will be 1 lakh value of portfolio into existing beta of portfolio. Generally, we assume zero when nothing is told about required beta. What is this? What is the logic? Understand that? Required beta means how much beta I have to maintain or keep in my portfolio. Beta represents risk. When I am multiplying value of shares portfolio with existing beta of 1.5, do you know what does it mean? Beta was my risk. I wanted to finish the whole risk of my portfolio. I was doing perfect hedging. I was finishing my whole risk. I was finishing the whole risk. If there is only that much beta in maturity, then overall gain loss will be nil. Beta is maintained. Did you get it? I was finishing my whole risk. The entire risk was being eliminated. So in that case, I wasn't getting the benefit of the favorable movement. It was a favorable movement. I wasn't getting the benefit. The portfolio maturity had risen. There was a gain but loss on the index future. So I couldn't get the benefit of favorable movement because I was hedging the whole risk. So now along with hedger, I am also a bit of a speculator. I have fear in my mind and some greed. I also need the benefit of favorable moment. So I said that I need to require 0.8 in my portfolio beta. What it means? 1.5 minus 0.8. That means I need to hedge risk of around 0.7. I am ready to bear 0.8 risk. If there is a loss of 0.8 in maturity, that I can bear. There is no problem. But if there is a favorable moment, then I will be benefited. Now see, if we would have hedged that much, it could be on profit. I am not going to go in revision, okay? So how much you have to maintain the required data? In the portfolio chapter, I have taught you the method about portfolio data management. There was a method using future contracts. This is the one. And no need to talk more on this. See ahead. If the number of contracts is in decimals, then round off it to the upper side. For example, 2.47. So consider it 3. Sir, how it is that? In market, we can't contract in decimals. Either do 2 or do 3. It is 0.47, 2.47. If I would have contracted 2, I wouldn't be able to have 0.47 contract risk. Some institute talk about doing it in upper side always. That full risk should be done in 3 contract. Okay, rest you can give answers in both of them, 2 and 3, or you can do 3 contracts in upper side. The one institute is doing. Don't put extra brain on this. After that, there is next step 3. Next step is to calculate overall gain loss on maturity due to hedging. Gain loss on index, future contracts and shares portfolio. You will get overall gain loss. Now we have written a note for index future contract. I have already taught you the topic of future contract gain loss. We find out that gain loss like that. Have made you write that right, but keep one thing in mind. If in the question rise and fall percent in price of index future is not given, suppose you have a question that how do we get gain and loss? Either we need maturity or we need the price of index future, so we can get gain and loss by differentiating the price of initial and maturity. If it is not there, then we need the rise and fall percent in the index future. Suppose this is not given and that is not given either. Now how to find out gain loss? In that case, you assume the rise fall percent of index or market. Index or market's rise fall percent is the rise fall percent of index futures. Have you understood? This will be given to you in the question. Index or market's rise and fall percentage. If Nifty has a future, underlying asset is Nifty. For index future, it's market. So I told you that Nifty has fallen by 2% on maturity. By 2%, and its index future must have also fallen by 2%. Because the underlying asset in it is Nifty only. Its price, the price of the future contract, must be derived according to Nifty only. In the starting, we read that the price of the derivative contract comes from the underlying asset. It will also fall from 2%, just the interest component is different. We learned pricing in the beginning. Rest the price will go according to the underlying asset. We have already seen this. Did you get it? So its price will also move according to the market, so you can take the index or market's rise and fall percent. But if the rise and fall percent in the price of index is not given in question, then it will be equals to rise fall percent in index or market. But you are not given rise fall percentage of index or market in question. Price of future of index is given. Its rise fall percent is given. So now let's take index, that is market's rise fall percent. We will assume it as the rise fall percentage of index or future. But if that too is also not given in the question, in that case the beta of the portfolio will always be given in the question. Without the beta of the portfolio, there will be no question of this topic. So you guys have to take the formula of beta which is given in the portfolio chapter, which I taught earlier, right? Portfolio of beta. Always remember the basic formula of beta of portfolio. Okay? Now don't tell that the security beta. What was basic? Percentage change in portfolio in comparison to percentage change in market. What is meaning of change? Rise fall percent. So what will be percent of rise fall percent in portfolio? Divide by rise fall percent in market. This is beta concept which we read. Did you get it? In this formula or in such questions, you will be given the rise and fall percentage in portfolio questions. Beta will be given for portfolio, and also that what is rise or fall percentage in portfolio after maturity. So can't you calculate rise and fall percent in index? In this case, how will the rise and fall percent in index will be calculated? Rise and fall percent in portfolio divided by beta of portfolio. This is the formula. It is written here how to calculate rise and fall percent in index or market when it's not given. Change percent in portfolio divided by existing beta of portfolio. These two things will be available in this. Means because of this, students are not able to understand the question and make mistakes. And the students who are studying from other people, they come to clear their doubts from me. How have you done? The institute is not running on a pattern. Your brain is not working properly. You have made mess of entire syllabus. If you would have studied in a structured way or in a mannered way, what you want is that a teacher come on YouTube and solve the questions for free. He is our God. He is teaching for free. He is ruining your life. You are not understanding this. When you are paying 20,000, you make him God. That he will show you practical trading. That is not what God is. They have kept you in a mess. They have not told you what you have to do, What is the real process never told you? You have got opposite knowledge. Got this thing? You will get rise fall percent in index or market. We have just taken beta's formula. We'll consider this as rise fall percentage of index future. We have learned how to calculate gain loss on index future contracts. Now gain loss on shares portfolio. This was not something to teach, but still. If your share portfolio has long position in the cash market and you have bought a share. If on maturity value of shares falls, then it is a loss. And if the value has increased, then gain. And if you had short sold the shares in cash market in the shares portfolio. In short sell, if the price increases on maturity, then it is a loss, and if it falls, then gain. This is the cash market that people understand. Now, how do we calculate gain loss? We learned if it's gain or loss, how to find out gain loss of share portfolio. Multiply value of the share portfolio by rise fall percent. That will be given in maturity. Rise fall percent in shares portfolio is not given. See, in those questions where rise fall index is given, we have to find rise fall percent in index like this, which is future rise fall percent. If you are not given rise fall percent in shares portfolio, in that question you will be given percent in index or rise fall percent in index future. In the whole derivative chapter, you have to consider that rise fall percent in index and rise fall percent in index future is equal or same. There is no difference in these two. You have to accept this, and I have given you the detailed reason for this in the class. Okay, rise fall percent in index or rise fall percent in index future. Both are same things. Then you can see that the portfolio is not given. It has given you the rise fall percent in index or rise fall percent in future. So what can be done in this case? See, you know the beta of portfolio's formula? Rise fall percent in index or index future is given. You know beta of portfolio. So can't you find rise fall percent of portfolio? How will we get it? Beta of portfolio multiplied by index or index future. So just tell with what have you multiplied value of shares? Existing beta of shares portfolio into rise fall percent in index or index future. We have got link of portfolio, so doing it wrong. Now the next and the last step after this hedging is complete. Last step is to calculate total portfolio beta on maturity after hedging. And it says to you after hedging, what is the beta of your portfolio? Which wording have I used here? Total portfolio, right? Till now I was using which word? Up to step 1, 2, 3 I had used word shares portfolio. Is there any difference between the two or written by mistake? There is difference. You will never find mistake in my notes. Whatever wording is there in my notes. Don't think I am exaggerating. I am just giving this information for those who have not studied from me. Those who are studying from me, they know how I teach. Those who are not studying from me, they think it's time pass. Because it's their habit to solve question for free, and they will consider him God. So their habit is bad. If I have written something, then I have written it after research. Here total portfolio is written, its meaning is different. What is total portfolio? There is difference in share and total portfolio. Portfolio means my investment where I have put money in assets. So shares portfolio means I have invested in shares. Apart from this, I can also have cash and bank balance in my asset. So total portfolio means shares portfolio, investment in shares plus cash and bank balance. So now I will tell you about the beta of the total portfolio after hedging on maturity. So what is the total portfolio beta of the entire portfolio? Why to look at beta of whole portfolio? Look at shares only as we didn't do hedging of cash and bank balance. Here it is written a note that cash and bank balance is a risk-free asset. Its beta is 0. We can never do the hedging of cash and balance. Why will you hedge the thing which is risk-free? We hedge the thing about which are afraid of. Why will you do hedging in which you are not afraid of? If there is a note of rupees 500 kept in my safe, then after 3 months it will be rupees 500 only. Now someone will think extra and say time value of money. We are talking about value of note, not time value of money. Note will be rupees 500 only. Are you understanding? It's not like if you get a 3-month-old note and it's mudded, then you will run it in market for rupees 100. It's not like that. So cash and bank balance is risk free and its beta is always 0. That's why we have not taken it into the step 1, 2, 3 for the purpose of hedging. Lastly, when it will ask you about the beta of the portfolio after hedging, then always remember that it will affect your cash and bank balance. I will tell you the reason why the cash and bank balance is affected after hedging. Even we didn't do hedging of cash and bank balance. Beta of total portfolio will be calculated by same concept, percentage change in portfolio, percentage change in market, that is rise for percentage in index or market. So we have to take percentage change of total portfolio. How to get percentage change in total portfolio? What is change in total portfolio? It is the gain and loss. We have to take overall gain and loss of the portfolio. Take overall gain loss on maturity of step 3. This is the gain of index future. Take it, I will tell you reason. Take overall gain loss and maturity as calculated in step 3 divided by. What was the total value of portfolio? Value of total portfolio in beginning multiplied by 100. What was the value of the portfolio in beginning? Investment which we did in shares portfolio plus cash and bank balance. Got it? Because percentage change in total portfolio. So understand why we took overall gain and loss. Okay. Now understand why overall gain loss has been taken. Understand that once. This example, look at this example. See in this example, in my index, in the future contract, I had a loss of 15,000 and gain of rupees 15,000 in the portfolio. So how much change was in the portfolio? Gain of 15,000. This should be taken as the change in portfolio shares. Why we are considering the loss of rupees 15,000 in index future? We are taking overall gain loss for portfolio change. Why are we taking this? If there is a loss in index future, then it is not a loss in the books, it is an actual loss. I have to give this money if there is loss. What I will do? I will take out money for this loss from cash and bank balance from my total portfolio. And if there was a gain, then it would have been added to the cash and bank balance. Means that due to hedging, my cash and bank balance fluctuates. Because what you do in the index will affect the cash and bank balance. That's why overall gain loss is taken on total portfolio. Okay, so this is percentage change in the portfolio divided by the market change. Then you will get the beta of the total portfolio. I will tell you what will be answer of step 4, just like step 2 is required beta of portfolio. In the question, required beta of portfolio will be given, that will be the answer. If you don't get time in exam, if you don't remember formula, then you can directly write required beta of portfolio. That will be the answer. If in any question we are not given required data or only calculation of steps are done, we did this type of question in the class. In that case, you have to calculate beta of the portfolio after maturity. You can see one example. We have completed hedging. Mr. A has made an investment in shares of various companies, which is 25 lakh in a portfolio. We need shares portfolio of beta data for hedging till step 1 to 3. This is given. Mr. A wants to reduce the beta up to 0.8. That means the required beta is 0.8 after this Nifty future. Currently Nifty future is at 20,000. Traded in multiple of timing. Nifty rose by 2% after 3 months. Market has increased by 2% in 3 months according to steps. First step, long position is at shares portfolio, then short position in Nifty. How many Nifty futures will you solve in contract? Value of shares portfolio 25 lakh into existing beta minus required beta divided by price of one contract 20,000 into 5 contracts are there. Next, overall gain loss. It is very easy. Now gain loss on index future. Is price or rise percent of index future given? No. You are given rise percent of Nifty. So assume that this is rise percent of Nifty futures 2%. What was Nifty future? Rise means loss. Loss on Nifty future is how much? Contract value 20,000 multiplied by 10 multiplied by 5. Now on shares portfolio, Nifty has increased from 2% portfolio's beta. How much? 1.2 of shares portfolio. It has not mentioned rise. So you can calculate the change. 1.2 into 2%. Okay. It means this much is the rise in shares portfolio. This much is the gain in shares portfolio. This is your gain. 25 lakh into 1.2 into 2%. Overall gain on maturity comes to be 40,000. Why it came? Because see here we have maintained beta till 8. And what happened in the market on maturity? Prices has increased. We thought it will fall. After that, in step 4, calculation of beta of portfolio after 3 months. Percentage change in total portfolio. How? 40,000 overall gain divided by 25 lakh total portfolio. Cash and bank balance is not given. So shares portfolio into 100, 1.6%. So much, how much beta? Change in portfolio divided by change in market is how much? 2% to 0.8. It is equal to required beta. You will say that there was no cash and bank balance in this question. Then why overall gain and loss? Here it was not about cash and bank balance. So the loss of 20,000 in Nifty future is adjusted by cash bank balance. It is not here. So brother, for you here in this question, Mr. A has a question inside this world. There is nothing outside this for Mr. A. This is an imaginary world for him. In his world, his portfolio is of 25 lakh. He doesn't have any cash and bank balance. That means if he has a loss of 20,000, maybe he will take out the 25 lakh from the portfolio and sell. He will pay from there. Then ultimately there will be effect on portfolio. This is his total portfolio. Try to understand that this is very logical. If you still don't understand, then remember this step. It is completed. Hedging using futures. See the last topic in futures and finish it. Arbitrage using futures. How will you use futures to arbitrage? It's not a useful topic for exam. See it quickly. How does an arbitrager work? It used to be a process, but now of no use. It's not even part of syllabus in module. You won't get anything. They have given few questions. That's why I am teaching it. No chance of coming in exam. If it comes by mistake, it's free. If actual quoted trading price of future is more in today's date, is less than theoretical fair price. If you take out the theoretical fair price, compare it with actual quoted price of future, then future price is more in the market, means overvalued. Future is product. Fair price is less, market price is more, it's thus expensive. And what should we do with the expensive thing? We should sell it. I told you that you should create a short position on the arbitrager future. It means that you should make contract to sell future, as it's downside betting. So this case is called cash and carry arbitrage in technical language. Do you know how much will be gain for arbitrager? Difference of these two. Actual quoted minus theoretical price of future. I have explained logically. Now quickly see. See, the share is of 2400. Calculating after considering 10% for 3 months, it will be to 2460. The future in the market is of 2500. Its fair price should be 2460, which we calculated right now. It means market price is more, so we should give base. It is overvalued. It will give gain of 40 rupees. Why? Because it means ultimately fair price is 2460, then it will at some time come to 2460. So we will short, then it is downside betting. So from 2500 it will some or other time go down to 2460. We'll get gain of 40. Got it? This is the logic. But its process is of no use. Some people make you study this process, but now this process is of no use. It is not in syllabus. It won't come in the exam. There are few questions which I have explained to you. You can see in regular class, and those who are studying from revision video, you can ignore. This has been discussed in class. If actual quoted trading price of future is less and the theoretical fair price of future is more, then future in market is cheap and undervalued. Cheap thing should be bought means long position on future. Buy future contract. This is called reverse cash and carry arbitrage. Why is it called reverse? Because something is cheap in the market and its fair price is high. There are very few situations like this. That's why. How gain will be calculated? Difference of two price. Theoretical price is more, so theoretical price minus actual quoted. Ultimately, the logic is that it will go near the fair price sometimes. Suppose today price in market is 2450. Theoretical price is 2460. It is more. Future is undervalued. Contract to buy can be done. It will sometimes go to 2460. So how much will be gained? Difference of these two is 10 rupees. Got it? Logic is same. Arbitrage was useless. We completed it quickly. No more time on this. Second part of this chapter is done, which was most important and time consuming part. Now the third part is most important part of this chapter. In this chapter, the questions according to my notes. Questions are made from these two parts. Majorly it will come from this. Part second was a little bit time consuming, but part third is not that much time consuming. It is a very easy part, so now let's start it. Now you understand. Part third option is equity derivatives. We started revision of concepts of derivative chapter and understood meaning of derivative. After this, I told you that there can be different derivatives for the underlying asset. So we are studying equity derivative where underlying asset, equity share or index is there. Because it is the main syllabus of this chapter, which can be of four types: forward, future, options and swap. Forward and futures are completed. Now come to options. Now we are looking at the options part. Equity derivative is the same as the contract for doing transaction on future bet. You can call it anything as per your will. What is the underlying asset in this contract? Equity, share or index. What will be extra condition in this contract so that we can call it option nature contract? If there is an extra condition, then only it will be option nature. How will we know that it is option nature contract? So meaning of options is written. What are options? Let's understand that. Which derivative contract will be called option contract? These are the most important thing to understand. So understand this. We are making a derivative a contract to buy or sell underlying asset on a future date at a prefixed time. Normal derivative contract is that if we fix an obligation on both the parties, then it is future or forward contract. Okay, got it? But if this derivative contract, that is contract to buy or sell an underlying asset on a specified future date at prefixed price. For example, I will buy Reliance share after 3 months at 2500. This I told to buy the contract and the other person said he will sell it on that specific date. So this is derivative of a normal contract. Now when will it become an options nature? When there is an extra line written in this contract. What will be that extra line? In this contract, it will be written that one party has a choice and one party has an obligation, which means that in this contract, one party has a choice, an option, or one person has what? A choice. What is the meaning of option? Alternate word is choice. Sometimes we say that I have an option, if not this, then that. We do say that sometimes. So what is the alternate word of option? Choice. So we are talking same that in contract, it is said that this party has a choice, it has an option given to it, and one party has an obligation. So a type of derivative contract where one party has choice and one party has an obligation. Both of them don't have the obligation. If both had the obligation, then it would have been a future or forward contract. One has a choice and one has an obligation, so it is an option contract. Sir, shouldn't both have a choice? I will tell you now that it can never happen. Okay, so one party has a choice or an option and the other party has an obligation. Now how is the choice? Now let's suppose there is a Mr. A. Mr. A said that I have a contract to buy. I will buy share of Reliance after 3 months at 2500. Mr. B said that I will sell Reliance shares at rupees 2500. These are the normal forward future contract wording. Now if it is an option contract, then do you know what will I say? That I am Mr. A and I have a choice in the contract. I will say that I need a choice. Then do you know what I will say? If I want, after 3 months, I will buy your Reliance share in rupees 2500. If I want, then I will buy share of Reliance after 3 months at rupees 2500. You have to sell. It means that I have a choice. If I want, I will buy it. I will buy it. Otherwise, I will not buy it. It is my choice. He has an obligation on his part. If I went to buy after 3 months, then he will have to sell it. He can't refuse. Okay? And if I said that I am not buying it, so he can't do anything. I can sit peacefully at home. Did you get it? Because I have a choice and the other party has an obligation. So what did Mr. A do? He actually converted contract to buy into right to buy an underlying asset. Are you getting this? I was saying contract to buy underlying asset. In case of option, one party has what? Right. So what did I took? I took right to buy. The right to buy the underlying asset means I have the right. I can buy it if I want and not if I don't want. It's all my wish. And the other party will be automatically obligated. Second party is Mr. B. So on Mr. B's part, there will be an obligation to sell. It means that if I reach him to buy, then he has to sell it. He can't run away anywhere. He can't say no. Do you understand? You all should understand this very clearly. Let's see an example. I said I will buy Reliance's share after 3 months for rupees 2500. I have told him that I can buy this share after 3 months. That is the choice I have. After 3 months, Reliance share in market is of 2600. So, will I want to buy? So this is logical. Upside betting is a contract to buy as there is profit. Think normally. We'll buy it for 2500 and sell it for 2600. Profit of 100. So Mr. A will exercise his option or choice and will earn a profit of rupees 100. So Mr. B will face a loss of 100 as he will buy shares from the market at rupees 2600 and will have to sell to Mr. A because he has an obligation on his part. Got it or not? Now see if after 3 months Reliance share becomes of 2400. Now tell Mr. A will use. Or will exercise his choice. Buy it? He will not buy it. He can buy if he want to. But why will he? As it is of 2400 in the market. Why to buy for 2500? The thing which is available at 2400 in the market, why will I buy it for 2500? I had a choice. I didn't have obligation. I will not exercise. I will buy it for 2500 and will sell it for 2400. Why will I want loss? So my profit and loss will be nil. Got it? So Mr. B has nil profit loss. In derivative, you have understood that profit of one party is equal to loss of other party. If one has a profit of 100, then other will have loss of 100. Mr. B can't do anything. If Mr. B had a choice, then he would have sold it because he bought it for 2400 and would have sold it for 2500. But he had an obligation. When will obligation come? When I will want. Otherwise, he won't be able to do anything. Got it? This is option contract. One party has a choice and the other has an obligation. You may have one thing in mind. Sir, one has choice and one has obligation. Notice one thing, that he is exercising only if he is getting profit, and when he sees a loss, he is not exercising. Means person who has choice in contract, he will never get loss, only profit or nothing. And the person who has an obligation, he is having loss or nothing. That means he can never get profit who is on part of obligation, because the other person won't let him get profit. It's true. So in such a contract, the party who has an obligation will never get profit. So why does the person enter the option contract? Is this contract feasible in practical life? It is absolutely feasible. How can it be feasible? Either the scenario is such that both parties have choice, which came to your mind. Let me clear it. This can never happen. Suppose Mr. A had a choice to buy it at rupees 2500 and Mr. B had the choice to sell it at 2500 if he want to. First scenario is price in market is 2600. A would want to buy at rupees 2500 as he is seeing profit. He will sell it for 2600. He went to Mr. B and said he has right to buy. What will Mr. B say? B told him that he also has the right and he can sell it if he want to, but he don't want to sell it for 2500. So finally the contract did not happen. No one had gain or loss. Now second scenario. Market price is 2400. Will Mr. A try to exercise as he can see loss? But what will Mr. B say? I want to exercise my right because I will buy it for 2400 and sell for 2500. Profit of 100. Mr. A will say I have right to buy. I will buy if I want, but I don't want to buy. So when both the parties have a choice, the contract will never mature in life. If you have made such a contract and someone has taught you this, then that person is a fool and you are also a fool to make contract. Because this is not practically possible. So in option contract, only one party will have choice and other will have the obligation. It will be mentioned in the contract. Any party can have a choice or it can request in contract. Here Mr. A must have said in contract that I will buy Reliance share after 3 months at rupees 2500. Then he would have asked for choice. So please give me one option here too in this contract. If I want, then I will exercise my right to buy. And you won't refuse, give me this too please. Mr. B showed his generosity and gave this option to Mr. A. It will be written in the contract that Mr. A has a choice and B has an obligation. Do you know what will be written in the technical language? Mr. A is option buyer and Mr. B is option seller. Sir, I didn't understand this. Look, Mr. A has an option, he has taken a choice. So he has taken a different product. He has bought an option from the other person. He has taken a choice, different product. Hence he will get a benefit. He will get an advantage. He has taken a product. This is called option buying. We has given him the choice to keep this choice. I will keep obligation. Mr. B will called option seller or option writer. Option seller is called as option writer and option buyer as option holder. Has an option and choice. A is called option buyer in this case. He will be called as option buyer. Did you get it or not? This point should be clear to you and Mr. There was a normal contract to buy or sell. So his contract was to buy and his was to sell. He said he want to buy an option. It became his right to buy and he is selling this option. It became obligation to sell. So option seller is always in obligation and option buyer is always getting right. And the right to buy or sell depends on the contract, which I will tell further in detail. So what is the benefit of Mr. B? Mr. B is giving an extra advantage to Mr. A. He won't give it for free. He will charge extra premium for that and ask for premium of option. He will collect money at 0 time. In derivative contract, settlement is on maturity. So settlement will be on maturity. What has Mr. B given to A? Option choice. Here you keep the choice. So against that, at 0 time, option premium will be collected. Money will be collected. Suppose I said rupees 50. I am giving you this option premium as extra advantage. Give me rupees 50 in 0 time in exchange. If 50 rupees comes, then Mr. B will do entire calculation. He will calculate the scenario, his loss on maturity, and then calculate the PV and all. We will learn how to take it out in practical life. Option contracts are also traded through stock exchange and their price is constant. We will learn how to take it out in practical life. I will teach entirely. Did you get it? This is option. It is very simple. One party has choice and the other has obligation. Now let's summarize it. Mr. A did contract to buy and B to sell underlying asset. It was a normal contract till now, but Mr. A asked for the choice, so Mr. B has the obligation. When Mr. A's choice was accepted, contract became right to buy underlying asset for him and opposite for B. The one who has a choice, his contract will be of right, and for other it will be of obligation. This person is option buyer because he has taken option, and he is option seller, he has given option. Okay, Mr. B is giving premium to Mr. A. This type of option is called as call option. That means such an option which has the Right to buy. What right the option buyer or the holder should have? Right to buy the underlying asset. Okay, getting it? What is the right of an option holder? Right to buy underlying asset. This is called call option. Now see the second one. Mr. A had the contract which was done by Mr. A was contract to buy underlying asset. Mr. B contracted to sell. This time Mr. B said that I want choice. A said, okay, I will keep the obligation. So now who will give the premium to whom? Mr. B will give it to Mr. A. The one who has taken the option will give it. Now tell what does Mr. A have? He has given option and he has an obligation. So he has obligation to buy underlying asset. What is Mr. B's choice? It is his right to sell underlying asset. He did contract to sell, so right to sell. So it is not necessary that the one who has done contract to buy should take it. One who has done contract to sell can also take the choice. In this case, who is the option buyer or option seller? If you answer this case properly after analyzing, then you will understand the topic. Rest, I will tell you about the market condition, which is very, very bad. In this case, option buyer is Mr. B and option seller is Mr. A. If you thought this, then you have understood conceptually what I have explained. Rest in the market, do you know what students study? Students there study that Mr. A has the contract to buy underlying asset, so he is option buyer. Option buyer and contract to buy underlying asset, these are two different things. Okay, contract to buy or sell an underlying asset and option to buy or sell is different thing. In this case, Mr. B has done contract to sell an underlying asset. But he had a choice with him, so he has bought the option. So he is the buyer of the option. He has bought the option. For which thing? Right to sell the underlying asset. Okay, right to sell underlying asset. So Mr. B is the option buyer. Right to sell underlying asset. And Mr. A is an option seller having obligation to buy underlying asset. This type of option is called put option. In this, option holder has the right to sell underlying asset, right to sell the underlying asset. Understand this only. This was your concept of option. Here I have written so you can read. In call option, option buyer has right to buy an underlying share on a specified future date at a prefixed price. So what will option seller writer have? Obligation to sell the underlying share. In output option, the option holder has the right to sell the underlying share and the option seller has obligation to buy the underlying share. Option premium is always given by option buyer to option seller. Now understand some features in options. First, option premium, which can also be called option price. Option buyer pays option seller in beginning of option. When he buys an option, he pays it at the zero time of the contract. As he has bought option that time, strike or exercise price. The prefixed price in the contract is called strike price or exercise price in the case of options. That we will exercise the contract at this price or strike it. There is right in it. So the price at which the option can be exercised by the buyer at maturity is called strike price or exercise price, which is our prefixed price. You can see in this chart I have written strike price near prefixed price everywhere. After this, when will the option buyer exercise option? It is conceptual, no need to remember, just look at it once. Call option, now you have understood when call option buyer will exercise. In call option, option buyer has right to buy underlying asset. Suppose for example I said I will buy for rupees 2500. When will I buy? When price will be more in market. Why will I buy? If the price is less in market. It will be exercised by option buyer if price of underlying share at maturity is greater than strike price under option. Now when will the buyer exercise put option? Put option means the right to sell underlying asset. Right to sell underlying asset. If I want to sell share of Reliance at 2500. So when will I sell? When price will be less in the market. So rate is less in market and I have sold it for higher rates. So I will sell it for 2500. When will I sell it? When rate is low. Okay. It will be exercised by option buyer if price of underlying share at maturity is less than strike price under option. That means the strike price is more and the price in the market is less. It is put option exercise. I have written one last feature in the option. It is not useful for any exam, but those who study from here and there, they say that you have not taught it, which has nothing to do with syllabus. Look at it once. Options can also be classified as European and American. It is theoretical. Understand difference between both. European option means options that you can only exercise on maturity, not before that. American option means you can exercise even before maturity. It's like future contract. You can exercise anytime even before maturity. That's all you have to remember. From exam perspective, you have to study European options. All the questions are of European options. Sir, if American option is written, then also follow the same method that we will study. You don't have to use any extra brain. Forget if you have studied extra from somewhere. If you haven't studied from my class and studied from somewhere else and you want to use your brain, then follow that. No need to watch this lecture. I hope you have got this. Now see further. Gain loss, payoff on option. In options, you have to find out the gain loss and payoff. You are seeing the same topic of options that we saw in forward futures. We also saw the pricing of fair price futures. I will tell you about such options, not now but later. First understand this. So in options, you have to calculate gain and loss payoff. Means settlement on maturity, gain loss and payoff. Okay. So in gain loss options, we will learn to calculate for the option holder. Let me tell you a simple thing. Who is option holder? One who has bought the option. It can be call or put option. Means right to buy underlying asset or right to sell same. So if there is a gain for the option holder, then it will be loss for the option seller. If it's a loss for him, then it's gain for other. I have told you that for the derivative contract, the gain for the first party and the loss for the second party is the same. So we will find the option by keeping holder in mind. Rest the same amount will be reserved for the other party. Did you get it? I have written it in the notes. Now understand option holder. In call option, when do we exercise this? When the price is high on maturity. Price of underlying share at maturity subtracted by strike price. Price is 2600 in market and strike is 2500. So we got a payoff 100. So we say we got a payoff. Okay. Now here I have written in bracket, if negative, consider it as 0. If someone reads conceptually, then it will not come as negative. He will take payoff as 0. See, when do you exercise call option? When the price is high in the market. If the price is low in the market, then you will say that you don't have to exercise the option, payoff is 0. Now assume that you don't work conceptually in the exam, so I have given you the format. Now just put the data in the format and get the answer. Suppose the price in the market is 2400 minus strike price is 2500. Payoff can't be negative. If it is negative, then consider it as 0. Why it can't be? Because you won't exercise it and you will note by a thing of 2500 which is of 2400. Then you won't exercise it. So if it's negative, consider as 0, put the data and get the answer. If you understand the concept, good, otherwise use format. So from this, less the option premium paid at beginning, we have to see the net gain and loss. Now I have 2600 subtracted by 2500. So 100's payoff. But for this, I paid the option premium of 50 rupees in the starting. So the overall gain loss here is of 50, right? So I have paid 50 rupees 0 time premium just to gain rupees 100. So the gain loss of rupees 50 is called what? Net payoff. Some students get confused in payoff and net payoff. Is it clear? See this carefully. Payoff is difference between strike and strike price. Net payoff means to adjust the option premium from payoff. How much net we earned? Net payoff is called the gain loss. So when you will get questions of gain and loss, you have to do like this. So do like this. Some students are confused in these kind of questions. But first see what is being asked in the question. Okay, if you study properly, you will not face any problem. This is the only problem that most students face in the options. The problem in payoff, net payoff, gain loss is you don't know what's going on. You have never studied the chapter properly. So have you understood what is payoff? Payoff is the difference between the price and strike price. It will come in use in the next chapter. Payoff is important in upcoming chapters. Gain loss and net payoff only up to this topic. Now what is put option? When do you exercise this? When the strike price is more. I have written the strike price above end price of share in maturity down. Consider 2500. If it is 2400 in the market, I will sell it for 2500, so payoff is of 100. If it is negative, then consider it 0. Suppose strike price is 2500, market price is 26, then why will I sell it for 25? So here it is showing negative 100, so consider it as 0. Okay, you got it? So like this. So option seller can also have gain. When he will earn gain? When option holder doesn't exercise. So for the one who collects option premium, the whole amount will work as gain. So let me give conclusion. If you see this example which I gave you here, option holder was Mr. A. A will exercise when there is a profit, and when there is no profit, he will not exercise. So do you know what is the maximum loss? Premium paid by him. If he won't exercise it, then it's a loss. But he will never face more loss than this. His loss is limited up to premium paid, but its profit can be as much as you want. It depends on market. But you know, option seller, maximum profit is limited according to the premium it has received. Because in the case where the option holder doesn't exercise, then it is the maximum profit. So its profit is limited, but do you know its loss can be unlimited? Why will the loss be unlimited? Because if the other person's profit can be unlimited, then loss can be unlimited too. So keep in mind that the loss of option seller can be unlimited, but its profit is limited. And for option holder, profit can be unlimited, but loss is limited. Now see the gain and loss on option for option seller. How will you calculate for option seller? First calculate for option holder. Gain of option holder is the loss for option seller. If the loss of option holder comes, same amount is the gain for option seller. I have written the same notes that I have explained till now. Payoff will always be equal to or greater than 0. This will never be negative. Option holder's gain can be unlimited, but its loss is limited on the premium he has paid. Loss can be unlimited for option seller and gain is limited of the premium he has received. You can verify it yourself too. See after this in the last note, break-even price of underlying share on maturity. What is this? So what do you think should be the price in underlying share in option contract at which no one face any gain or loss in any party? Nobody in the parties in contract should face gain or loss. Gain and loss comes 0. So that price in the market is called break-even price. It is very easy, just think logically. Watch it. Now you understand in the case of call option. In the case of call option, how does the payoff come? Price of underlying asset in maturity minus strike price. In the case of payoff, if you make the option premium minus, then you get gain loss. This is what I have taught you in the table. I have written it in the form of formula. Now what I am trying to know is that what will be the price at which the gain loss will be 0? So make the gain loss 0 in the formula. So how much should be the payoff here? If the payoff is equal to option premium, the payoff will be equal to option premium. If payoff is equal to option premium, then gain loss will be 0 for both the parties on maturity. If gain loss is 0 for one party, then it is 0 for second party also. Then in this situation, payoff will be 0. So in this formula, the payoff is equal to the option premium, not 0. If I put option premium instead of payoff in this, what should be the price of underlying asset on maturity? Option premium, and if strike price is in minus, it should be in plus. Option premium plus strike price. So on maturity, the price of underlying asset will be equal to option premium plus strike price. It will be strike price plus option premium. So net gain loss will be 0. Let me verify it. Strike price was 2500. Option premium was 50. So break even means 2550 if on maturity 2550 is the price of call option. So you won't face any gain loss. Price is 2550. 2500 is strike price. Payoff is 50 plus option premium is 50. So net gain loss 0. Got it? Simple. Sometimes institute asks questions like this. What is the price on which the option holder will get the gain after going up by 1 rupee? So this is called break-even price. Or question like this. Option holder can gainfully exercise the call option on any price above this break-even price of underlying share at maturity. Understand this is break-even price. What it means? Price is calculated to 550. If the price goes up by even a single rupee from break-even price, then the option holder will gain in this case. It became to 551. See 1 rupees gain. This means that the option holder will gain over a call option at a break-even price. In the case of put option, how will the break-even price come? You can check the break-even price according to the same formula. It's strike price minus option premium. Strike price minus option premium, if this will be market price, then no party will get a gain or loss in this price. And if the price goes below this price even by 1 rupee, then the option holder will get a gain. So option holder can gainfully exercise the put option on any price below this break-even price of underlying share on maturity. It was a useless point, but have a look at this example. Mr. A took call option of 1 share on ABC Limited for 3 months. Premium 30 rupees, exercise price 500. Calculate the gain and loss of Mr. A after 3 months. If the price of share is 650, call option. So 650 minus strike price 500, we got the payoff 150 less option premium. This is the gain. This amount is loss for option seller. Second scenario is 400. 400 price minus strike price 500. If the payoff is negative, then we have considered the payoff 0. Less option premium means loss of option holder. Same amount for option seller. That was the topic. Now see the next topic. Expected value of option at maturity. We want to see the expected value of our option at maturity. What is this topic and what is this trying to tell? At 0 time, I am entering in the option contract with the other party and I am taking the choice. Suppose call option, I am taking right to buy option. If I want, then I will buy the underlying share after payment 8 rupees 2500 if I want to. For this I am paying an option premium of rupees 50. So now I want to check if the option that I am paying to the other person is justified or not. Will I be able to get that much value from this option? The contract of option, this extra choice I am taking, will I be able to get that much value from it? So at 0 time, I want to see what value I will get on maturity, because future is unpredictable. What value will I get on maturity? We will get to know what is the price of underlying asset on maturity. No one has seen the future. So what should we do? Sir, in such a case, you put an expectation, put an estimation. What can be the price at maturity? That is, find the expected value of the option at maturity. What will you find? Expected value of the option at maturity. Check what expected value can we get from option. What expected value can be obtained from the option? Because you don't know the actual value. We found out the gain loss by standing on the maturity and took out the gain loss. Think once, make a situation in your mind. What we were doing? We knew maturity and then calculating gain and loss. In this case, I am seeing at 0 time that I am paying option premium. So how much expected value I will be able to get from maturity? It is very easy. What can be the expected value? So for this, you have to know the expected price. What can be the price on maturity? Compare that price with the strike price and see the payoff on maturity. Compare it with payoffs and check how much will you get. But why should we compare it with the payoff? Because the payoff is against the option premium. We are getting payoff in exchange of option premium. So we should also look at net gain loss by subtracting option premium. We are not looking at net gain loss on maturity. We are looking at what we are getting in return of 50 rupees premium. If I minus this 50 from this, then it is a net gain loss. I want to see that if I give a premium of 50 rupees, then at maturity, what will be the value in exchange? So I will calculate the payoff of maturity. We will only find payoff. I have told you about payoffs earlier also. I have told you the reason of taking payoff. You don't have to calculate net gain loss of maturity. You have to see that the premium that you are giving today, can you get that much value from this option? See how much payoff will you get? See what you will get in return of this. Calculate what you will get. And don't think about what net you will get after using this. There is a minute difference in both wordings, so listen carefully to this. 50 rupees option premium which I am giving, I am calculating what I am getting against it on maturity by calculating expected value. I am not looking at what net value I got by paying this. I am looking at what I will get by paying this. What will I get in exchange of this? Okay, so we will compare it with payoffs. So what will be the price for payoffs on maturity? We don't know, so we will put an estimated price. So if we put an estimation, then we will put many prices. We will say that this might be the price. See one example. We will say that I am estimating the price on maturity at 0 time, taking out the expected value. What will I get from call option? Right to buy at 2500. So I saw that on maturity share price can be of 2400, 2500 or 2600 or 2700. It can be anything. I have put an estimation of 4 prices after full analysis and write the probability of what are the chances of these. So now look at the payoffs at every price. If there is a price of rupees 2400 in the market, then what will be my payoff? I will not exercise call option, then it will be 0. You have learned to calculate payoffs, right? Price of underlying asset minus strike price. If it is negative, then it is 0. This is what we have learned about call option payoffs. This is same to same. At 2500, it is 0. If it is 2600, then payoff of 100, 200 if it's 2700. Means I can get these 4 types of payoff on maturity. Sir, tell me the final one. What is the expected payoff? What is the probability of these 4 payoffs? The probability of the prices is the same as the payoffs. The probability of the price of rupees 2500 is the same as the payoffs. Multiply the respective payoff into the respective probability. So you will get a total of 60 rupees, which is my expected value of option at maturity. The end. Means by entering in this option contract, I can see the expected value of the payoff. So the expected value I can see here is 60 rupees. So I will get a payoff of rupees 60 by spending rupees 50. It means you will say that it is justified, right? Now you can take out your net gain loss if it becomes rupees 60 minus rupees 50. You understand what you are getting in return? 60 on 50. Okay? This is the expected value. Some people will say that we have paid 50 today. We will get 60 in future. We should check PV. We will read that in next topic. This topic talk about only the expected value. What is expected value? So I explained this. So if multiple expected price of underlying share on maturity is given in question, then expected value of option at maturity is calculated as follows. Expected value of option at maturity is equals to payoff 1 into P1 plus payoff 2 into P2 and so on, payoff n into Pn. It means that take out the payoff at every expected price and multiply with respective probability. It's a simple topic with few questions which you can figure out easily. Now please come to the next topic, and this topic is your last topic of the third part, okay? And then the third part, the major part, will also complete. Value of option at beginning or fair value of option. And this is the most important part from which generally questions can be made. Now you must be thinking as soon I said the last part that, sir, our last teacher, the knowledgeable teacher, had taught us so many things. He taught us so many strategies and things. He taught us about how to do hedging and arbitrage. Let me tell you that this chapter of equity derivatives is focused on equity derivative. Okay? This chapter talks about equity derivative. In equity derivatives, we have seen hedging and arbitrage in forward futures. This is the part of syllabus. But in the case of options, the hedging and arbitrage part of the equity derivative is not a part of your syllabus. Okay? They are giving you unnecessary knowledge for no reason at all. And that is why you are getting confused. So this is how simple it is if you follow the syllabus. So I will only teach you the syllabus. And those of you who haven't been taught by me, don't message me later. That, sir, you haven't taught us this. I already have given the clarification. We are studying only the syllabus. Only what is in the syllabus. Then you will say that our teacher had taught us currency option in hedging, which also has a question in the module in the Forex chapter. So if that is under the topic of Forex, then trust me, your teacher is mad. Why did he taught this? As I said that we will read derivatives of currency in the Forex chapter. So it should be covered there. So there is options of hedging under the currency options. The equity doesn't have it. So why should I mix that topic here? The rest of the people are so illiterate that they don't even know how to bifurcate the topic. And such people are sitting on the position of teachers. They don't know how to handle the course and how to teach it. That's why they mix up everything. They are altogether teaching equity, currency, and even interest rates are including in the same topic. Then what to expect from them? And so that's why the students have no idea about what to do and how to do. Here I am addressing other student, not my student. I am telling you this for your sake. There are some students who purchase my question bank and study it. And when they reach derivative chapter, they say, sir, you haven't included this question of option hedging. Our teacher say it's a modules question. Then I tell them, if you know it's a question of module, then see which chapter's question it is. Option is in Forex chapter. Entire options hedging is in the Forex, note here. Equity is not a part of the derivative. So they don't even know what they are reading and which chapter is in their syllabus. And suppose some questions in the module are included in another chapter, like topic of equity buyback is a part of merger chapter. In the module, they have put a question in the security evaluation. Now some stupid students study from God knows where. And then I don't know why they take the question bank when they don't even trust it. And they say, sir, there is no equity buyback question in your question bank. We trusted your question bank. What to do now? So don't waste your money if you can't compare properly. So equity buyback can be found under the chapter it belongs to. I teach chapter by chapter. I teach topic wise and chapter wise. Those who are studying in my class, you can ask them. So equity buyback is a topic of merger and it can be found in it. Similarly, there is one question of constant proportion plan which is included in chapter of mutual fund in module. They search it in mutual funds question banks. So basically they want compilers of those stupid teachers. In compilers they put illustrations, test your knowledge, RTP, MTP, past paper. I don't have to publish that type of question bank. I can say just take the print of SMP, RTP and MTP and leave. Question bank need hard work, not just compile unnecessary things together. Hard work means to put it topic wise, chapter wise and from easy to hard. You can check everything is topic wise here. So those who don't work hard, you won't find their content in our booklet. If they suit you, then you can read from them. Please don't waste your time here. And also don't waste my time by sending such messages. Or else you too will get replies like that. Now let's see the value of the option at the beginning. Come to the topic, so much knowledge for today, but it was necessary. Value of option at beginning, which means fair value of option. Now let's understand what this topic is. To find the value of option in the beginning. The thing which I told you a while ago, the expected value of option at maturity is of the future. In today's time, if we compare the option to the premium, then whether it is justifiable or not should be compared with today's value. So calculate it by PV, and that's what we are going to do. In the beginning, what should be the value of the option today? What should be the value of the option today? Till now we were seeing what is the value of the option on maturity. Now we will see what should be the value of option today and what does it mean. Fair option premium. Fair option value, how much the option premium is supposed to be. That is what we want to see now. This is the topic. There are two models of this in your syllabus which are very easy. There is only one useful model, binomial model. The second model is of no use for the exam. It has never appeared in the exam till date. Still, we will look at it quickly. Our main focus is binomial model. Now let's see how to calculate the value. I have already told you the crux of it. So what we have to do to calculate the value of option? We have found out what is the expected value of the future option on maturity. If the value is of future, then we have to bring it as PV today, then we will get the value for today. How to do PV? By dividing the factor. In simple interest, 1 plus R into T and continuous compounding e to the power RT. In practical life, it is continuous compounding. Okay, so according to our institute, we will study both methods. Did you get it? So this is what you have to study within this model. So this is the right way to get the value. So why are there two models for it? Why? You will get to know its reason in a short while. And sir, is there any other formula in the model for it? There are still some things in it which we still have to talk in detail. Now, if a person has given his theory or model, then there must be some other things in it. Let's read it once. But I have told you the crux and logic of how we can get the value. Crux will be same, but there are little assumption behind every model. Whenever I have taught you a chapter, if there is a model, I have told you that all the economists and theorists, when they make their models to calculate anything, they have some or other assumptions behind it. No model could be made without any assumptions, it's a fact. So there are two assumptions behind this model which you should know. Whether these assumptions will be asked in the exam or not, no. Then why are you telling this? For those slow students who seek more knowledge, who ask why is this happening, another scenario could have happened. This is happening because it is written in the model. What is the first assumption? First assumption is C. Now you have to calculate expected value of option at maturity and find PV. How to calculate expected value of it? Prices on expected maturity, payoff into probability. So you have to calculate the expected price on maturity. So till now we were calculating whatever expected and estimated prices on maturity. But what does binomial model do? Binomial model says that on maturity, the expected price of your underlying share can only be 2. Either the price can move up from today's price. It can either move up or move down. Means there can be only 2 possible expected prices on maturity. If you take more than 2 possible expected prices, then you will not be able to apply binomial model. Let's suppose today your Reliance share, the underlying share in my option contract, is running at 2500. So either the price on maturity could be 2600 or 2400. It can be anything. It means from today, either it can move up or it can move down from today's price, means only 2 possible expectations. There should be only 2 possible expected prices at maturity. So this assumption will be applied, and this is its first assumption. Now, what does those oversmart people do? Sir, suppose we get a question which gets 10 prices on maturity. What will we do then? Tell us. It's not possible. Then the binomial model won't be applied to it. Did you get it? So I have to tell these assumptions to satisfy their curiosity. Second, return on option will be the same as risk-free return. The return that you are getting on the option is the same risk-free return that the amount of return you get from investing in the risk-free security in the market. It's same. If I would have given the option seller a premium, suppose a premium of 50 rupees, how much return would he get? Assume if he invests it in the bank, then he will get a risk-free return, and after 3 months it will become an interest of 50 plus. So in the market, in the option contract also, we will say that we are getting a risk-free return. Risk-free return, what this model is trying to say is that if you calculate the expected value of option at maturity, then its PV should be of risk-free rate. Its PV should be of risk-free rate. In this chapter, in whichever model we do the calculation, we assume risk-free interest rate. Okay, in the market, the risk-free interest rate is in trend. We take this assumption in this model too. Understood? Moving forward, look at one more unnecessary point. This model shows 2 approaches to calculate the value of the option at the beginning. There are 2 approaches in binomial model. First, the risk-neutral approach for the option holder to calculate the value at the beginning of the option. Second is delta hedging or riskless hedge portfolio or replicating portfolio approach. Seller used this option to calculate the value of the option at the beginning. Do we have to study both? What are we supposed to do? I am going to give you a summary, just remember the names. From both the approaches, the fair option premium which will come, it will be similar from both the approaches. Ultimately, let me tell you that both the approaches are the same. There's no difference. The risk neutral approach, if we present its formulas in a different way, then it becomes the delta hedging approach. No difference at all. Then why they made it? They are mad. They have done it in practical life. Option holder thinks from this approach, and option seller thinks from the delta hedging approach. Difference is in approach. So there's nothing else. Ultimately, the answer, everything is same. There is no special approach given in our syllabus under the name of delta hedging. In your syllabus, it is given under the name of neutral approach. This will be your common approach, and according to this, we will find the solution. This will come in your exam, can get full marks. Its calculations will be done stepwise. Nothing to worry about. The answer remains the same both ways, and you don't have any other thing named delta hedging in your syllabus. But still, I will tell you a little bit about delta hedging and how it is done. I have already taught you that in the class. Use it here as well, even if it comes in exam. Delta hedging, riskless hedge portfolio approach, don't worry. Use the normal steps to resolve. As I said, the process is exactly the same. They have just shuffled it. And ultimately, the answer will be same, get full marks. They do it intentionally just to make tough. As I said, those who have read the chapter, they get confused. So I have cleared the doubt here. Now let's see how we will calculate the value of option from binomial model. Keep other things aside, main thing is exam. So for the exam, first of all, if your question is about single period binomial model, how will you solve it? Now what is this? First you told us two approaches in binomial model, and now this. Those are just approaches. We have taken a common approach. See what is single period binomial model? Just a question of binomial model in which one more assumption is added. What is it? The price of the underlying share on maturity, first and only time on it once, is going to change. It will either move up or move down. As said, that price of my underlying share in the contract, its price today is 2500. Maturity is after 3 months. So that day, either its price could be 2600, move up from today, or 2400, move down. That is on maturity, the price for underlying share will change for the first time. Whether it moves up or moves down, we will know that day, but for the first time, the price will change on maturity. This is called a single period binomial model. Will change for the first time. Second is the two period binomial model. Must have understood it. We'll study it later. We will focus on single period. It's easy. All you need to do is, it will take 4 steps to resolve. First, make binomial tree. Institute does the same, and we will also. It becomes easy to solve the question. Binomial tree is nothing. It is exactly what I have made. See at 0 time, write 0 time or maturity for 3 months, the end of your first period. Today the price of underlying share is the price of current underlying share. Expected price of underlying share when they move up and at bottom when they move down. How much is the probability of this and this? Here we will see the chances. What are the chances of expected price being either? Why you wrote the probability P and other as 1 minus P? There are only 2 possible prices. If the first possible price is P, then the probability of the second price will be 1 minus P. The total of the probability is always 1, basics. Understood? So this is what you have to do. 0 time first period means maturity. 2 nodes emerges from the current price of underlying share. Expected price of underlying share moved up and moved down. First probability and the 1 minus probability, both are found. After this we have named each node. I have named this point as point A, this as B, and this as C, which we also used to call node A, B, and C. Helps in calculations. There is nothing special in it. You can name them anything. We have named this point as node A, this point as node B, and that point as node C. Got it? Now make a tree of this ones. After that, what would you do in step 2 is that you will do risk neutral probabilities of price moving up and down. Now let's see what's this. Whenever you will get this question, you will have all the data in the question only. Calculate expected value of option at maturity or do PV. To find the expected value of option and maturity, expected price of that day is needed. Only 2 prices are possible here if this comes as question. So move up or move down, both will be given in the question only. So the strike price will be given, yes it will be. Payoff can be calculated, yes it will. If multiplied by probability, expected value will come, yes it will. But probability won't be given in the question. You will not be given the probability that what's the probability of the price of move up and what will be for move down. We have to calculate that. Even if it is given, we will not use it. I will tell you later why. First, we will understand how to calculate it. We will calculate risk neutral probabilities of price moving up and moving down. Probabilities that we calculate here, the assumption we take is risk neutral. That's why it's called risk neutral approach. We calculate the probabilities risk neutral. What I said, the assumption in this model is that the return will be the same as the risk-free return in the market we are getting. The return that we are getting in risk-free security is same as the return given in market in option. So now when we will find the probability, means we need to find the expected price for move up and move down probability. Then we will assume that if there is a risk-free return in the market, means if there is a risk-free return available in the market, then this price should be according to the probability. We will assume that there is a risk-free return available in the market. Risk-free rate of return is there in the market. That is, the amount is same as risk-free return in the security offered in the market. If it is same, so in this case, what will be the probability? So what should be the probability in that case? Listen, we are assuming the amount of return we are getting on risk-free securities is the same as the amount of return on risk in the share market. So according to this assumption, what should be our probabilities? It has a formula, which I will explain, but first see the formula. How will we get the probability of price moving up? Calculate the probability in 4 decimals. E raised to the power RT minus D divided by U minus D, or 1 plus R into T minus D divided by U minus D. You must have understood why there are two formulas. In continuous compounding, e raised to the power RT, and in simple interest 1 plus RT. Now there is no need to repeat it, as I had already taught this same thing earlier also. Okay. So how did this formula was derived? What is there in this formula and what data is given? So I am going to explain the example with logic. See, I have made a binomial tree. There is no issue in this. If we want to find risk neutral probability, so let's assume that there is a risk-free return in the market. In this case, what should be the probability? So what should be the probability of getting a risk-free return in the market? It means the expected price in move up and move down is given in the questions. You either multiply by P here. Its probability will automatically become 1 minus P. Now, as you have done this price in this way, now you will get a single expected price. It's simple. You calculated the average price. We took average of two expected prices by probability and get single expected price. Now this single expected price that is in the market, let's think how it's being calculated. We assume that we are getting a risk-free return in the market. Means if you add risk-free return to the current share price, then you would get future price. Now we have the future price. So if we convert the future price to PV from risk-free return, then future price is starting 0 time price plus risk-free return. So to PV the future price means to remove return from it. So if we do PV with risk-free rate, then we will get the current price of underlying share. So we find the average of futures expected price. So this is the price of the future. So if we PV this with the risk-free rate of return, which is continuous compounding or simple interest, then it's equal to the current price of underlying share. I had already explained it in much detail. Now we don't need to go in depth in this topic. Now if you keep expanding this formula more, then ultimately you will get this formula again, same formula, and in this formula you can put expected price move up or move down, put rate of interest, time and current price, P1 minus P will get automatically calculated. You can calculate probability from this formula also. The institute writes it like this, nothing else. And now see, there is U and T also. Now look at the meaning of U. U means expected price of underlying share at maturity move up divided by current price of underlying share at 0 time. What is current price of underlying share at 0 time? And in the numerator, the expected price of underlying share at maturity move up. That means upside movement. Means how many times can the expected price move up from the current price? And now see, D means how many times can the expected price move down from the current price? Means expected price of underlying share at maturity move down divided by current price of underlying share at 0 time. R means interest rate per annum and time means number of months till first period end, means maturity divided by 12. This will be your probability and you can calculate by this if you want, with which this formula is made. This would be the moving up probability, and the move down probability can be done by 1 minus P, which is here you got the probabilities and prices on maturity. You can find payoffs. If strike price is given, we will find it out in step 3. Payoff on each node of first period. On maturity on every node, there will be 2 nodes. Find payoff on both the nodes. You will get the payoffs. If you multiply those payoffs with the probabilities that we have calculated, then you will get expected value of option at maturity. So check step for value of option at beginning. Expected value of option at maturity. If you want to do PV, then divide by E raised to the power RT or 1 plus RT, depend on continuous compounding or simple interest. Binomial model is that simple. Single period is complete. See the example, current price share is rupees 400. Either increase to 480 or decrease to 300 after 3 months. So it is 400. Can be for 80 or 300 as well. This is binomial tree of binomial model. Find the value of 3-month call option. Strike price is 450. Interest rate is 12%. No binomial model is mentioned. After looking at the data of the question, we are understanding what needs to be calculated. So learn to understand this by looking at the question. You would automatically understand which method will be applied to it. If you have to find the value, then step 2, risk neutral probability. You have to find it. So what is U? 480 divided by 400 and D, 300 divided by 400. Apply formula continuous compounding, and if nothing is given then simple interest. 1 plus rate of interest 0.1 to 12%. Multiply by time 3 by 12. Minus D divided by U minus D, probability. 1 minus P, we got probability of move down. Now in step 3, take out the payoff on each node. You can further directly show that in the tree here as well. Okay. I made you do the same thing in the class as well, that we took out the payoff here. And further just wrote it directly in step. What will be the payoff at the price of 480? 450 strike price. If we exercise call option, then payoff will be 30. And in case of 300, I won't exercise, payoff will be 0. Okay. That's it. So payoff is calculated in the step 3. In step 4, value of option at beginning, expected value of option at maturity. Payoff 1, how much? 30 into probability 1.6222. Second payoff, it is 0. What is the probability in this case? 0.3778. This is expected value divided by 1 plus rate of RT, which is 1.03, and you will get the value of 18.12. PV done. The second one is the 2-period binomial model, and it is also same. There is a special point in it. Just see that there's not much difference. What happens here is the underlying share price will move up and down even before maturity and also during maturity. But before maturity, it will once move up and move down, which means it will change twice. It is applied when price of underlying share will move up or move down before maturity for the first time and again for the second time. Means the underlying share price will move up and down during maturity, and it can fluctuate before maturity also. In this case, it is called 2-period binomial model. Solve such questions in 5 steps. 1 step will increase. First of all, make a binomial tree. Here it will be a little big, 0 time, then first period, then second period of maturity. Look at the example. Now you will understand. Here I have made a scenario for example. Now see here, you all, current price today is 2500, today's share price. Now suppose maturity is for 1 year. One option is there whose maturity is for 1 year. In between the period where prices may increase or decrease, anything can happen. That will be exactly half period in most of the questions. Generally it will be half. So in 1 year, 6 months. If it was 6 months option contract, then it would be 3 months. If it was a contract of 2 years, then it would become 1 year, generally of half months. So price can be 2600 or 2400, move up or down, anything is possible. So from 2600, it can be 2700 or 2500 also. It can be from 2400 to 2500 or 2300, move up, move down. So this is your 2-period binomial model. How many nodes are there? How many points are made? A, B, C, D, E, F, G. Remember, there will be points till G only. Sir, is it also possible to have 3 or 4 periods? Absolutely, but it is not in syllabus and so it will never come in the exam. Firstly, it is not in the syllabus, so it will not come. Also think how big will become if you go to 3 periods. If every branch emerges from here, then how big will the branches be? You won't be able to solve the question. The logic will be same. If you understand this, then you can solve 3 or 4 periods, but it will never in exam. So don't bring this query. Okay. Make chart that 0 time in first period, in second period you get maturity. Current price of underlying share in 0 time. Price move up, move down. And then from move up, move up, move down, from move down, move up, move down. Probability of move up, move down is P and 1 minus P. Then move ups P, 1 minus P, then below move up is P and move downs 1 minus P. Nodes name A, B, C, D, E, F, G variable. Clear? Now second step is to find risk neutral probabilities, that is price move up, move down. Now how to find it? To find risk neutral probability, we need UD in the formula. In U, we needed expected price of underlying share move up divided by current price of underlying share. And in D, expected price of underlying share move down divided by current price of underlying share. This was needed. Other than this, we needed number of months under time. So now this prices of move up are so many. One of the price of move up is this. Understand the concept of move up. This is one price of move up. For move up, one price is this and another is this. I can see 3 prices. Which one should I take? Similarly, for move down, we can see this price and also this price. Which one should I take to find U and D? It will be very confusing. Till where should we take the number of months? From 0 to first period, or from first period to second, or from 0 to second period. So how to calculate the probability in this case? In this case, to find out the probability, we should use which data? Which one? Don't get confused for this. The assumption of this model is that the probabilities of move up and move down in first period will be similar to the probabilities of move up and move down in second period. Probability of move up and move down will never change. It will remain same. This is the assumption of binomial model. So what you do is use data only till the first period. Okay, students? Forget the data of second period. Focus on the data of first period, which is marked in red, which used to be in single period. Focus on that data and find out probability, and that probability will be in second period also, which you can use. So for risk neutral probabilities, consider first period only. Since probabilities will be same for second period, moving up has same two formulas now. Expected price of underlying share at first period, move up divided by current price at 0 time. In this to move down of first period divided by current price 0 time interest rate. Time will be first period, number of months till first period divided by 12. Did you get it? Means you have to consider the data of only first period in order to calculate probability. And the probability of moving down is 1 minus p. Complete. So it is simple, and this is exactly the same like single period. Step 3, find out payoff. Payoff will be on maturity only. Payoff can be find out on each node of second period maturity. Payoff will only be on maturity. So maturity D, E, F, G are 4 nodes. You will find out payoff by comparing the price and strike price. You got the payoffs. What you need to do? In step 4, you will calculate one more thing. You will calculate value of option at each node of the first period. At every node of first period. See, there are 2 nodes. Node B and C. Calculate the value of option at these 2 nodes. In step 4, we are not taking out the value of beginning directly in this case. Why are we not taking out the value of beginning? Now listen carefully. You must have a question in mind that okay, we will find out the payoff on every node. You can see how much payoff have I calculated. Check carefully. Price of strike is 2500. So in 2700 it is 200. In 2500 here 0, here 0, here 0. We got the payoff. Now you might be thinking that, sir, you have told in your binomial model that there can only be 2 expected prices of move up and move down. But here we can see 4 prices at maturity. You are able to see 4, but it is only 2. Your point of view is wrong. Okay, you have to change your way of looking. How? If you see carefully, there are only 2 possible prices. All 4 prices that you can see here, it is impossible for these 4 prices to be together. All 4 prices can never be at the same time. Why? Because price 2700 and 2500. When are this coming? When at the end of 6 months the price is 2600. Then it is possible. These 2 prices are dependent on 2600. If it is at the end of 6 months, then the 2 prices will be there. So it's possible in this scenario, and if in 6 months it becomes 2400, then these 2 prices are possible. It means that all 4 prices can never be together on maturity. It will depend here that which price will be on the maturity. Did you understand? That's why you can't bring the expected value directly from maturity to 0 time. Now you have to split it in parts. It's a binomial tree. Tree means branches. Here if you reverse it at 90 degree like this. So it will be like this. First node, B and C node, D, E, F, G node. C branches are opening like a tree. So first you calculate the value of all the 4 upper branches by bringing them here. Then you will come down from here. So you will come from top to bottom while calculating values. Just remember, so you take these 2 prices in use, find out this value. What do you have to do by taking these 2 in use? Find out that same expected value of option at second period maturity considering node D or E. Consider these 2 and calculate the expected value, that is payoff multiplied by probability, and bring it here by doing its PV. How much time to do PV here? The time from here to here. How much time is it? 6 months in our example. So here we got the value of node B. Similarly, now by considering node F and node G, find the expected value of option at maturity in the second period and then bring it here by doing its PV. Now we got the value on this node. We have also got the value at node B and the value at node C. Okay, you got this. Now what should you do with the value of these 2 nodes? You should find their average by probability. Value at node B into P, value at node C into 1 minus P, which is the probability of these 2. So this is the expected value at the first period. Do its PV and bring here for that much time. I mean, you are just coming from top to bottom and nothing special. See? Step 4, calculate value of option at node B first. Expected value of option at second period and maturity considering node D and E, do its PV. Similarly at node C by doing PV of expected value of node F and G. How value of option at beginning in step 5 will come? Option. Value of option at node B into P plus value of option at node C into 1 minus P, then its PV. See example, 400 is the price. Consider 2 time periods of 6 months each. First period for 6 months, second 6 months means maturity will come at end of first year. And in each period, price of share of ABC Limited can move up or down by 20%. So price of ABC Limited shares can move up or down by 20%. It can be given like this: from 400 increase and decrease by 20%. Then from 480 increase and decrease 20%. Increase and decrease 20% from 320. Find value of 1 year call option. Strike price is for 50 and interest rate is 12% per annum. In step 2, calculate the probability considering the first period data of 6 months. In step 3, find the payoff maturity. See the payoff of maturity. These are the 4 notes of second period's end. In step 4, find the value of node B. What will be the node B value? How much is the payoff at node D? 126. And 0 at node E. So multiply these with probability. Do PV and value comes at node C. Got the value. What is value of option at beginning? Value of option at node B into probability plus value of option at node C into 1 minus probability. It was a simple topic and is completed. Just see the notes. I have explained it earlier. Which type of interest, simple or continuous compounding? If it is specifically said, then continuous compounding interest rate, otherwise simple. After this second note, if we get the probability of price moving up and moving down in the question, which you will surely get, in that case ignore the given probabilities, because those probabilities are according to our estimation. In binomial model, we need risk neutral probability. There is assumption. Find risk neutral probability and only this will be used to get the value of option at beginning. Okay. The given probabilities will not come in use. They will be used for other calculations in the question. But from binomial model, you have to get the value of option at beginning, so use it. Third, expected rate of return on option. This is asked in a question in which probability is also given. It is useless. Syllabus doesn't cover it at all. Just understand it. What will be the expected rate of return on option? Return means gain or loss. So what will be the expected gain or loss on option? At 0 time, we'll see the expected gain loss. How will this come? Expected value of option at maturity. What's that? How much payoff will I get today? Considering probability is given in question. If probability is given in that question, then take the given probability and use and see what is the expected value, which will be your payoff. If we minus option premium from it, then we will get net gain loss, right? So minus option premium, that is value of option at beginning. If option premium is not given in question, then find value of option at beginning from binomial model fair option premium. If not given option premium, then consider it equal to fair option premium. In denominator, that same option premium, we have to see how much return we got. So what we invested is option premium only. On it, whatever return gain loss happened, it came on top and multiply it with 100. Simple. Last note under this is determining composition of riskless hedge portfolio. That is combination of share and option to have a perfect hedge. What is this? This is the point of delta hedging. What have I told you in delta hedging? Is clash hedge portfolio approach. This is used by the option seller to get the value of the option at the beginning. They have just modified the process a bit. Ultimate value of option at beginning will come same. Answers and everything all will be the same too. Now what is it? Let me explain. Delta is sometimes asked in questions, so I explained it. Look now what we do here in this word delta. What is it? It's actually a mathematical term in statistics. It is denoted by a triangle. What does it represent? This represents here. Now option seller uses delta hedging approach. So think from his point of view to sell one call option. An option seller, I mean, how many underlying shares should be bought by an option seller so that it becomes a perfect hedge for him? Clear? So if I say option seller, I sell a call option, then what does it mean? I gave a call option, meaning right to buy an underlying asset is given. So I have an obligation to sell an underlying asset. Meaning if he comes to buy a share on maturity, then I will have to give him. Now what do we think in binomial model here? Risk-free return, which means we follow riskless approach. We work in such a way that we don't have any risk and we get risk-free return. So the option seller wants to get risk-free return and stay riskless. He does not want any risk. So you know what will he do? He will buy the underlying shares today itself. So that on maturity, when the other person comes to exercise his right to buy, I give him the shares. I must buy my shares today itself in such a way that I get a perfect hedge and a risk-free return so that I can stay riskless. So how the option seller can perfectly hedge himself? How can he be hedged perfectly? Okay. Meaning today, how many underlying shares should option seller buy so that one call option? So that on selling the one call option, he does not face any problem. This option seller gets a risk-free, riskless return and gets perfect hedging. Okay, this is what we need to find. Delta is used in this calculation. This is called determining composition of riskless hedge portfolio. So my riskless hedge portfolio has been made. How did it get made? Because I am buying some shares in my portfolio and selling a call option. So this is also called portfolio. Combination of share and option to have perfect hedge. I will do a combination of share and option. I will buy some underlying shares to sell one call option. Now I have to find out that how many underlying shares should I buy today so as to sell one call option. It is delta's formula. We will not go in its explanation as it is not in syllabus. 1 or 2 questions may come. You should know that. What is the formula of delta? Payoff at node B minus payoff at node C by expected price of underlying share at node B minus expected price of underlying share at node C. Ultimately, do you know what are we doing? The first period which was under binomial tree, the first period, remember? In the first period, the differences which we are getting in our payoff, the changes that have occurred by change in the prices, consider that. In denominator, see the changes in expected price of underlying share. In first period, what changes are there in payoff in both the prices and change in underlying? Shares is expected prices. Take that in denominator. This is delta, guys, okay? Suppose delta is 0.50. Then this means that if I am selling one call option today, then I should purchase 0.50 underlying share today. How to purchase 0.50 from share market? This is mathematical. Suppose I sell 2 call options in the market. I will purchase 1 share. Call option is of Reliance's share. If I sell 2 call options of Reliance's share, I will buy 1 share of Reliance's share. As it will mature, right? So in this situation, I will get a riskless return. It will be a perfect hedging for me, and you can verify it. That I have told you in the regular. So that's all for this topic. Let's move ahead. So now the second one is Black-Scholes model. To find value of option at beginning is fair option premium. You have 2 models. First is binomial and second is Black-Scholes model. I have told you that binomial model is relevant for your exam, but the second one is useless. It's a waste of time as this Black-Scholes model is not going to come in the exam. Why it doesn't come? There is a formula in it which is really very weird. Because it needs mathematics. And if you put data in formula, you will get the answer. Nothing special. See, you apply Black-Scholes model when expected price of underlying share is not given in the question. When the expected price on maturity is not given, then how will you get expected value as options payoff will not come? So in that case, in the question, standard deviation or variance of underlying share is given. In underlying share prices, what standard deviation or what variance changes in prices can come? In percentage. You had learnt in portfolio, right? So that is given. So if we use it to calculate value of option at the beginning, then it is Black-Scholes model. So looking at the questions data, we can understand if it is Black-Scholes or binomial. Expected price is given, then binomial. Standard deviation variance given, then Black-Scholes. In practical life, suppose if you see your expected price to be more, then you can't use binomial. So then Black-Scholes. Now if you want to calculate value of call option at the beginning by Black-Scholes model, but however in binomial model the method is same only. Call option or put option as payoff will come accordingly. There it's nothing different. But here it's different formula for call option and put option. We'll tell you separately for both. Let's see. So here you have to find the value of call option at the beginning, right? Its formula is current price of underlying share into ND1 minus strike price is PV. Here PV is done by continuous compounding, so you know that in denominator e to the power RT means PV. And in practical life, continuous compounding works. So the institute did well here. Here continuous compounding works, multiplied by ND2. How this formula is made? I had given complete logic of this formula in the class. Telling you in short, it won't take much time. See, our main aim is to do PV of expected value of option at maturity. Now how to get expected value of option at maturity? We are talking about call option here. Sir, what will be the price on maturity? Expected price minus strike price payoff multiplied by probabilities. So this will be your expected value of option at maturity. Now if we don't have the expected price available with us, then in that case we will take only one scenario. For its PV, this is in denominator. So now you all open the numerator of this formula, which is expected price into probability minus strike price into probability, and then it's PV. Why we are opening it? Because we can't put data in this formula as we don't have expected price. That's why we are using Black-Scholes. Now open it more. Expected price of underlying asset divided by ERT into probability. Here we took this and here we took this. Strike price is PV into probability. On opening, this will come, which I had verified mathematically. If we do PV of the expected price, then what will happen? There is a risk-free return in the market, so in the expected price, risk-free return is added with today's price. If we do PV, then we'll get current price of underlying share into probability, okay, minus PV of strike prices into probability. This is the formula. Denoting probability with ND1 and ND2 R stands for interest rate per annum. T stands for number of months till maturity divided by 12 for option contract. ND1 means probability of increase in price of underlying share at maturity. ND1 means the amount of probability of increase in price of underlying share at maturity because we exercise call option when the price increases. So current price is multiplied by probability of increasing price. If call option is not exercised, then value will be 0. What is ND2? ND2 is probability of exercising the call option on maturity. See with what ND2 is multiplied? By strike price. Because if option is not exercised, then same thing. Value will be 0, that is why we took this. Now how to find out probability, how ND1 and ND2 will come, how to find. To calculate probability, a standard normal distribution table is there. I have taught this in detail in risk management chapter. Who don't know, watch the revision video. In standard normal distribution table, there is a z-score against which the cumulative area is given. That cumulative area reflects the probability, so we need z-score and standard normal distribution table. So you have to find z-score. This z-score is being called here as D. So z-score 1 is D1, z-score 2 is D2. 2 z-score will be here as there are two probabilities. And we see the values in standard normal distribution table, so ND1 and ND2. Value means we will see cumulative area, which means probability. If one tail area is given, then do 1 minus one tail area and cumulative area comes. Where was it? In risk management, I have taught everything about standard normal distribution table in detail. You can revise from there. Still, I have given that knowledge of statistics, which you may not have learned at school level. It is there in full detail and the same reference is here. I will not teach that again, understood? So the same thing is here. So we have to find z-score, which we are calling D1. So let's first find D1, z-score 1. Formula of z-score 1, natural log of current price of underlying share divided by strike price plus interest rate plus half of variance into T divided by standard deviation under root T. What is z-score 2? Same formula. Just remember one thing, you see plus here, just minus in place of this, that is z-score 2, which is D2's formula. But there is a shortcut for this. What shortcut? From D1 standard deviation under root T. That means minus the denominator of D1, denominator of D1, so D2 means you will get z-score 2. Both the z-score are found. We have to see the value of both the z-score in the standard normal distribution table. See the value in it, it's the probability. That value will be given to you in exam, that this value is on this z-score, cumulative area, cumulative or one tail area, you can convert into cumulative. Okay. So you have to get z-score from formula, ND1 and ND2 will be given to you. ND1 and ND2 is cumulative area. Correct? Just put data in the formula and you will get value of call option. Ln in the formula stands for natural log. Sigma sign is for the standard deviation. Okay. Then R in standard deviation. Use interest rate and standard deviation in decimals only in formula in this chapter everywhere. Its reason is told in basic mathematics and in class. Now how to calculate value of put option in the beginning. It is very easy. Strike prices PV minus current price of underlying share plus value of call option at beginning using Black-Scholes. Find and add it. I have given you the logic that how this formula was made. When do we use put option? When the strike price is high. So you must understand that in this case also same logic is there. You understand above formula, right? Derivation of what I have explained until now. I have kept strike prices PV into ND2 first in the formula, minus current price of underlying share into ND1. Why? Because we exercise put option when strike price is more than market price. What you have to do in this? Where ND2 do 1 minus ND2 and when ND1 do 1 minus ND1. If you open this formula, do you guys know what ultimate crux will be left in this formula? Strike prices PV minus current price of underlying share means ND1 and ND2 will be removed, and instead of this it will become formula of calculating the value of call option. That's why we find value of call option in the beginning and then we add strike price PV minus current price of the underlying share. So we get value of put option in start through Black-Scholes model. Now check if the dividend income on the underlying share is also given in question in the fixed amount. Then wherever current price of underlying share is coming in formula, subtract PV of the dividend income from it. Same logic as pricing of forward futures. This is also like pricing of fair option premium. Here also cost of carry logic will work. So do the same thing. One will be subtracted from here and other from here. it will be adjusted from current price. Or if you are given yield percentage on dividend income underlying share, then wherever rate of interest R is coming, it will be subtracted from dividend yield rate, which we denote by Y in formula. Same logic. Black-Scholes is over. With this, I have revised whole concept of the third part of this chapter. The most important part is complete. Now let's quickly revise two useless parts. Part 4 swaps equity derivative, in which we have completed forward futures options. Last is swap. Derivative contract is on underlying asset, equity share or index. It is of swap nature. So how will a derivative contract become of swap nature? Contract will be same for doing transaction on a future date. Now how will it be of swap nature? What should be written in the contract? Very easy. Swap means exchange if we talk about its Hindi meaning or look at its synonym in English. To change something among us or to exchange, okay? In future, I will be exchanging things. What will we exchange in the future? Derivative contract is for the future. In future, we will exchange equity swap. I am going to exchange something from equity. Something of the equity, something of the equity. I will exchange something from equity means exchanging something from share or index. In this, there is only one topic, which is equity swap, and you will not get it in module. Telling this only because of a question which is not even useful for the exam. This has the meaning and calculation too, then it's over. Let me tell you what does swap means. I will give you an example. Suppose there is Mr. A. He has invested 100 crores in a shares portfolio, means money is in equity. Mr. A has invested the money in the portfolio, but he is a bit afraid that he has invested money in shares portfolio, but in the market return can be less or negative. I wish I had invested this money in fixed income security or in FD. At least I would have got a fixed return. He told this to his friend Mr. B. Now Mr. B is becoming greedy and he is thinking that there are chances of getting high returns in the market. Chances of getting high returns. I told that people do derivative contracts because of fear or greed. He is afraid and other is greedy. So what did he told to his friend? Don't worry, I am your friend. He is thinking that if I would have invested 100 crores in fixed security, I would have relaxed. But now there will be tension. So no problem. I will give you a fixed return of 1% per month. We call this 100 crores a notional principal. 100 crore notional principal. I have decided I will give fixed return of 1% on 100 crores in your account. In return of this, you keep transferring me the return that you will earn on your rupees 100 crores shares portfolio. Okay, brother? Then whatever happens in exchange, don't betray. He said, I don't have any problem now. What happened after a month? I am Mr. A and how much is 100 crores 1%? 1 crore. Mr. B will give me 1 crore and how much I will give to Mr. B? Whatever I have earned in my shares portfolio this month. Suppose I have earned 5% in my share portfolio. Now I can't refuse to give to Mr. B. I have to give it since this is a contract. I have to give. So 5% of 100 crore. I will pay him 5 crore. Will get 1 crore. So I have loss of 4 crores because of this contract and the other person got 4 crore profit. Derivative contract is future contract. The transaction will be in future. We have fixed contract today. Don't know if this will be profit or loss because we don't know the return on share portfolio. So derivative contract. I was talking about exchange. Yes, exchange. That means equity exchange share portfolio's return. I am giving this to the other person and taking fixed return from him. Taking what? Fixed return. Simple. It's exchange of return percent in equity shares portfolio with fixed percent between two parties on notional principal amount. Decide notional principal. It is not compulsory that we will do on 100 crores. It can be done on 70 crores. In reality, Mr. A and Mr. B are not doing any transaction of 100 crore. We are swapping the return on it. We are exchanging it. We are just exchanging. Okay. It is like I said to my friend that your girl is good. Let's swap our girlfriends. Got it or not? So this doesn't happen in practical life. Otherwise, his girlfriend and my girlfriend both will beat us very badly. So we can't do this in practical life. But in this case, you may assume that it is good contract and will give benefit. Until you go near it, you won't get to know the profit and loss. Francis' girlfriend looks good from distance. Later you realize that yours was better. Similarly, see what happens in this case. Mr. B thought I will get good return on shares portfolio, so let's give him fixed percent. After a month, there is a return of 0.2%. He will get 0.2%. How much is 0.2% of 100 crores? 20 lakh. Mr. B will get 20 lakh and how much will he pay Mr. A? 1 crore. It can be loss also. So now in this case, if you think little more, then there can be a negative return in the shares portfolio. Assume that there is a negative return of 2% in the shares portfolio. In this case, Mr. A will get a fixed return of rupees 1 crore at the end of 1 month from Mr. B as fixed return. Who has to transfer shares portfolio return earned? Mr. B. How much did he earn? Minus 2%. Whatever it is, it has to be transferred to the other person. Even if it is loss or negative return, it will be transferred. Minus 2% means minus 2% of 100 crores. Means loss of 2 crores will also be transferred to him. In this case, Mr. A doesn't have to pay anything. He will get a fixed return of 1 crore from B. Plus, A will get loss recovery of 3 crores from Mr. B. He gets 3 crores profit and B loss of 3 crores. Did you get it or not? This is swapping. Now this is complete. One party will pay amount equivalent to return percent in equity shares portfolio on notional principal. Another party will pay amount equivalent to 6%. Now how much is net payment received or paid on a particular date? Particular date will be decided in the contract. Like I said, per month. In contract, it can be decided that in every quarter, I will make a fixed payment and you will pay whatever you have earned in the share portfolio. So we will decide every month, every quarter or 6 months, it can be anything. We will also decide the total tenure. Suppose we will settle every quarter for a total of 4 quarters. After that contract is over, we will do this for 4 quarters, so it will last for a year. So on particular date, whatever decided in contract, how much is the net payment received or paid? To which party? Calculate fixed amount for receiver. Who is fixed amount receiver? Fixed amount receiver is one who is transferring the returns of equity shares portfolio and wants a fixed return. What is the net payment for that? We will talk about him because it's equity swap. We are swapping the return of equity. The other one is who is taking the return on shares portfolio. He is a variable amount or floating amount receiver. His amount is not fixed that how much will he get. It depends on the return on shares portfolio. Got it? So if you ask his, it's the same calculation. If my fixed amount is receiver's profit, if I have lost, the same amount is profit for him. This is derivative contract, so no need to write it. It's talking about fixed amount receiver, means I am transferring return on equity and taking fixed return. Net amount received paid, so let's see how much is received. Amount received on notional principal at fixed percent. Notional principal into fixed percent. And how much will I have to pay? Amount equivalent to what? I have to pay only return percent in equity shares portfolio on notional principal, means return percent in equity share into notional percentage. This is all that I have to pay. Are you guys getting it or not? It will be the same for the other person. If profit for me, loss for him and vice versa, it's over. This was your swap. Very simple. It is completed. That's it. Next and last part is part 5th of this chapter, commodity derivatives. In this chapter, I told you that any underlying asset can be in derivatives. It can be equity, which we did entirely, or forward futures, options, swap. This is the main focus of this chapter. If commodity is an underlying asset, then we have to read it in this chapter. So now we are studying its practical portion, a small practical portion. It is not in full detail like equity, just a small part of one topic. We will study the practical of syllabus only. Apart from these, for currency and interest rate derivatives, there are separate chapters. And all the other derivatives discussed earlier will come under theory portion, not under the practical portion. We will see it there. Secret point is that you don't get theory questions from practical subjects. If you get it by mistake, it can be for maximum of 4 marks. Otherwise, you won't get it. Okay? You don't have to waste your precious time on that. Now let's complete this last part, commodity derivative. I already told that commodity derivative is the underlying asset in which there is a commodity. It can be rice, wheat, bajra, copper, gold or any other commodity underlying asset. Okay? Let's suppose if I think that the price of gold will increase after a period of 3 months, then I can make a future contract of buying gold. Okay? Or I can do betting upside or downside betting or contract of selling. Just like we were doing in the case of shares. But as it is, everything is same. Only wording will change and commodity will come in place of shares. Rest all things are same. The only practical topic which you need to study is hedging commodities using commodity futures. How to hedge commodities using commodity futures. This is what we have to study, not options or swap. No, in practical part, only commodity futures is there. In that too, how to do hedging. That is all, so don't waste your time. So what are commodity futures? Future contract on commodities. Means I have made a future contract for the underlying asset of commodities. How we will do hedging? Same step to be followed to solve equation. First of 4 steps is which position should be created in commodity future. It's the same as index future. What position will I take? It is a long position in the cash market. I have purchased a lot of commodities. So what will I do? I will create a short position in the future of that commodity. We'll do contract of selling. And in cash market, commodity is shorted. Short sell, it means sold commodity after borrowing. So what I will do in the futures market, I will buy long positions in the commodity futures means I will do contract to buy. Upside betting sim create reverse position. Sir, commodity futures are also on stock exchange. Yes, on exchange, but not on stock exchange. Stock exchange is for share exchange. In India, commodity exchange is MCX, okay? Those who do trading knows about this exchange. In this also there is a cash market on the ground floor. Assume that our commodity is gold. If you want to buy or sell gold, it will be done on this floor. If you want to do a future contract on gold, then go to first floor derivative market. Same only name of exchange is changed. MCX and nothing else is different. Second step, number of commodities, future contracts to be bought or sold. How many contracts should be bought or sold? We got to know buy and sell. How many contracts we have to do? It is same like that. So here to find the number, please pay attention. When we were talking about index futures, we were calculating the number of contracts on the basis of amount, right? Here instead of amount, it is based on quantity, that how much is quantity of commodity. So instead of amount, quantity. Total quantity of commodity divided by size of a future contract. One future contract is for what quantity? Example, I have bought 10,000 kg gold. I am afraid that price will fall. So I will do short position on futures means I will do contract to sell, downside betting. Sir, you have 1010 kg gold. Let's tell the income tax people. Don't tell them. If I had this much, I wouldn't have been teaching here. Gold is not that much. I have, but not that much. How to calculate number of contracts? So a total of 10,000 kg of gold is to be hedged. One future contract on which there will be betting will be of 500 kg of gold. So how many contracts you should do? 20. You have to find number of contracts on the basis of quantity and not on the basis of amount. Keep this difference in mind. See here, formula is total quantity of commodity divided by future contract. Size. One more thing is in formula, total quantity of commodity multiplied by hedge ratio. What is this? Sir, you didn't explain this hedge ratio. It is not tough. This is beta of commodity. Like in case of shares, value of shares portfolio into beta divided by price of one future contract. This was it, right? So instead of price and value, we took quantity. No problem. Now beta, where did beta went? So like in case of shares, beta tells how much share portfolio will change in comparison to market. Okay? In case of commodity, instead of beta, we call it hedge ratio, ITS beta only. It tells you that in comparison to the market, how much will be the change in the commodity. Because market of commodity also exists. I just told you that there is an exchange MCX and there is also an index of this exchange. Index or market, whatever you call, it also has an index value. And on this exchange, commodities like gold, copper are being traded. Alright, there are a lot of commodities. Now this exchange will have an index and a market too. Yes, a market. Okay, it is index of MCX. So if we are doing commodity futures, so if we do adjustment of gold with gold's future or we'll try to do hedging of gold with gold, then hedge ratio will be 1. Okay guys? As I said to you about the respective share future, if you want to hedge one share, then you should take one share future. So assume the hedge ratio as 1. That's why I have written in the notes that if hedge ratio is not given in question, then assume it as 1. In this case, we will assume that we are hedging the commodity with the respective commodity future. Here I have not created detailed topic of commodity and respective commodity future. It is not in the syllabus in such detail. Because of 1 or 2 questions, we are seeing practical topic. When will hedge ratio come in use? When I am using the future contract on the index commodity, I mean the index of commodity. The one I have, which is gold, will use for hedging. So I have to hedge gold by using the index future of the commodity. Different change will come in index future and in gold. How will it match? Beta. What is beta? Hedge ratio. So in this case, you will need hedge ratio. It will be given in question or you will have to calculate indirectly. Generally, you will have to calculate. What is its formula? Hedge ratio is equal to RSF into sigma S divided by sigma F. Means correlation between change in spot and future price into standard deviation of change in spot price of commodity divided by standard deviation of change in future price of commodity. Sir, what is this formula? How is it made? It is formula of beta only. Hedge ratio is beta only. Beta's formula was written in portfolio chapter. Correlation between security and market into standard deviation of security divided by standard deviation of market. I have explained it in the lecture. This was formula of beta which is given in the portfolio. So what was in beta's formula? A standard deviation of security or of market. So here in hedge ratio, how to calculate for commodity? Standard deviation of spot price of. What will be change in commodity spot price? Standard deviation of commodity is given. We need this commodity in place on F security. In divide, we need standard deviation of market. What is coming here instead of market? Index of commodity. What is index future representing? Index. Okay guys? The change that will come in index future is the same as in index. Change in future price is given. In that standard deviation in future prices of index, standard deviation of change is given. It means change of market. That is what we needed. Market standard deviation. Okay? In which case will you calculate hedge ratio? When you are taking the index future of the commodity. So in this case, what is the underlying in the index future? Index. So the change in the index future will be same as the change in index. This is how it comes in the question. So you have to take the correlation between these two. Commodity and index. Okay, commodity means export and future. Understood? So there will be one question. You have to calculate hedge ratio in it. This data is given, calculate. I explained it little bit. It has been taught in class. It's done. After this, if hedge ratio is not given, then we'll assume 1. And if data is given in question, then we will calculate like this. Now see note 2 in step 2. Exposure in commodity futures. Sometimes it asks the amount of exposure in commodity futures. That is what was the amount to sell or buy the contract. Here asking the value of contract, nothing else. Price of one contract into number of contacts. So number of commodity future contracts multiplied by future contract size into actual quoted trading price. If you multiply the actual quoted trading price by the future contract price, then it will be one contract price multiplied by number of commodity futures. So commodity value is nothing but just written in different way. Okay. Now third step, calculate net cash received on maturity after hedging. Now change is in third step. There we were looking overall gain loss. Here it's not that. Here it is that how much net cash will be received after hedging on maturity. When we come to the question of commodity future hedging, then you have the same scenario. In cash market there is long position, so we bought the commodity. So in future market we might create short position. Okay. So we are looking at the situation according to the exam because the syllabus does not say anything like this. So now when you will sell your commodity on maturity, because I bought commodity gold and I was afraid that the price will fall after 3 months, so I will get less money to sell. So in maturity you have to sell it at the actual price. It will sell on that price only. Future contract is created, might give gain or loss due to cash settlements. The amount received from actual sale of commodity, if sold on maturity, what will be the amount? Quantity of commodity into actual spot price, whatever the spot price will be. After this, if you do commodity future contract, there will be gain and loss. If there is gain, then it is plus because the amount is received, and if there is loss, then it is minus. Clear? How will be the gain loss calculated? It will be the same as above we saw in future contracts. In equity, number of future contracts into contract size into difference between the maturity and contract price. Difference of initial contracted price of future and settlement price. It is same, nothing is different. It's just that you have to think of commodity instead of share. After this, last step, step number 4. Calculate effective price realized from sale of commodity on maturity after hedging. What does it mean? They might ask. Tell me after you are done with hedging, when commodity was sold on maturity after hedging. So what is the effective price you got or realized on selling the commodity? What did you get per kg? What they are asking per kg cost you got? I mean per kg price. So what is the total amount received on maturity after hedging? You know that net amount, net cash received on maturity after hedging. This is the actual amount received. Might be some adjustments in gain loss on future contract were made, so net cash is received on maturity after hedging. On what? On total quantity of commodity paid will be divided by total quantity. We will come to know what was the pricing we have received on selling. I mean to say the pricing per kg will be realized here. It is very easy and basic. There is nothing special in it. You don't have to memorize the formulas. It is all logic here. With this, you have completed part 5 of commodity futures. No commodity derivatives in full. This was your practical part. In the syllabus, there is nothing more than this in it. I have covered all the practical concepts of this chapter and revised all the concepts in detail here. Now you should not have any problem in this chapter. Those students who have studied from me, they know it very well. They have understood the whole concept. I have given you all the questions in the class. We have written those. So now what you have to do is, I hope you have listened to the revision video. Make sure to read notes and the questions we have solved in the class in lecture. Please refer to the solved question. Have written all the questions in class and solved them in detail. So you have to refer these solutions and your revision will be easy and quick. I have written all the questions of each chapter. You won't get stuck. If you go through all of them, I am sure you won't get stuck anywhere. Still a doubts, please message me. The students who are directly watching the revision video and have taken classes somewhere else, I have given you the complete crux of this chapter in the revision video. Whatever I had to tell you, I told you. After this, please go through the notes. Which notes? Concept notes, please use them. Go through them once. After that, if you look in the question bank which I have created, I have arranged the question in sequence as we are studying here, which is topic wise. You will find the heading with the name of topics we study. I have arranged them from easy to hard. So just read the topic from the notes. See the question and then solve it according to my steps. As I told you to solve it by yourself so that you will learn. Then you match the solution with the question bank because the solutions is for and as per whole institute. So if you make a working note up or down, then you get confused. They don't show some things. I take all the answers stepwise. I take all the calculations with which you will get completely 100% marks, which I teach you in the class. There is no miss out in this for which the marking is there. It gets covered in everything. So you have to apply these steps and get your answers for each question. Then you have to match it. Seeing direct answer won't work. And please don't message me for sharing the solutions we practiced in the class. No one will be able to share it. I also make my class students practice. I make them write one by one in the class and make them solve and note it in the notebooks. Not going to share or given to anyone. Rest of the students should not message for this year and my time will be wasted in replying. Because I don't do like some other teachers. If someone's messaged me and they need help and I ignore it. I reply to each and every student's message, so don't waste your time, mine too. While studying, if you have any doubts, do message me. Don't worry even if you are other student. I clear all the doubts. You can message me anytime. If you have a problem, simply tell me. Hope you must have understood this with ease. And in class, I have said it seems tough to everyone. With the help of my learning, guaranteed. For sure it will be easy. Now you yourself tell me. Whether you found this chapter easy or not, you yourself comment or message me how did you like it. And if you give your feedback, then I can improve from it and I get motivation from it. You tell that sir you have explained well, it makes me happy and nothing else. I will just wait for the same thing, that the feedback you give. On that basis we will continue working in future. If you like the lecture and the way I teach, then you can suggest your juniors about it. If you didn't take the class, even then it's okay. You will get support from here for exams. And if you have any doubts, you can ask me anytime. You can suggest your juniors, you can recommend them for classes. The support that is needed from you guys. My hard work is there and God's blessing are always there. Keep studying. If you have any problem, message me and like the video. If you can understand what I am teaching in the revision video, like it, comment it, because it gives an approach to the video. It will help other people because only then YouTube will suggest. So that's all for today. Thank you so much. Hare Krishna.